and North Atlantic is one of them. So I think that the meeting they are going to have today and this task force is going to be important. It's only a first step, but we still have an opportunity to save the summer, and it's an opportunity also to restart a UK economy, to protect jobs, to connect people, because we have some people that for more than 1 year they are waiting to see their family.
Mr. Gallego, let's talk a little bit about sustainability and also your own resources. Clearly, the airline sector is highly stressed at the moment from a financial point of view. Can you deliver on what you think needs to happen in terms of making the transition for the airline sector, given the financial fragility that currently exists?
Yes, sustainability has been key for us. IAG, we were the first international airlines group that we made the commitment to reach to 2050 with net zero CO2 emissions. After the COVID, we maintained that commitment. Last 22nd of April, we said also that in 2030, 10% of our flights will be powered by sustainable aviation fuel. We are investing $400 million also to develop sustainable aviation fuel. And also we are participating with some innovators developing what can be the aircraft for the future. So the commitment is even stronger than it was before. It's true that as a consequence of this crisis, all the airlines, we are going to be smaller and with a huge amount of debt that we need to repay. But the commitment with the sustainability is there, and we are sure that we are going to arrive to the objectives that we established.
Mr. Gallego, many of those that are watching this program will be business travelers. They will be waiting for the North Atlantic to reopen. They will be waiting to get back onto planes. Nevertheless, do you think, from a sustainability point of view, that we should be encouraging business travel to come back? Do you think that is something that we should rethink? We've all learned that Zoom calls can do some of the business that we need to do.
I think business traffic is going to come back. We see that 3/4 of the corporates that we talk and the customers, they say that they are thinking to travel internationally by the end of the year for business. So, and it's true that in parallel we have the sustainability issue. But what we are doing right now is to take action in the short term, and for that we are investing in the latest technology that we have for the aircraft. And you know that in IAG we are receiving 787-350s that are aircraft that they can reduce the fuel consumption up to 40%. And also we think that in the short term, sustainable aviation fuel is an important solution, and for that we need the commitment from the different governments, because it's not only a question of the airlines, it's also the commitment to invest in that technology, to have enough plans, and at the end the price of sustainable aviation fuel has to be competitive in order to allow us to arrive to the levels that we have committed.
Luis Gallego, the CEO of IAG, joining us from Heathrow as part of the A4E conference today. Sir, thank you very much indeed for your time. Tom Keene, hopefully that North Atlantic will reopen soon. We are missing you here. I think this is an event, the G7, that was built for Tom Keene's presence, to be honest.
Well, I would have been thrilled to be there. It was going to be a ho-hum meeting, and it's not ho-hum at all. We'll have much more from Guy Johnson on this with Jennifer Jacobs and Josh Wingrove in Cornwall as well. Lisa, your thoughts here on inflation? I mean, the news flow in 2 hours, we get this inflation number. I'm looking at core. I know Jan Hassi is writing up on a very narrow, sticky inflation, a trimmed inflation, I should say, which is still really much contained.
Yeah, although it's interesting, we haven't mentioned anything about the initial jobless claims, other than mentioning they're coming in at 8:30 a.m.
Yes, thank you.
But people are actually more interested in jobs than the CPI print, because as Peter Hooper was saying, everybody's looking past that. Nobody cares. But people are looking more at employment because they want to understand when wages actually start to come up, to understand the stickiness of the inflation.
Man, she's dazzling how she does that. She's 100% correct. I mean, claims is actually probably a bigger deal than inflation.
Well, especially wages. You know, yesterday you had Luigi Zingales on the show, and his most recent podcast was asking the question, why have we seen prices increase over the past decades, but we haven't seen wages for the American worker come up? And that's just a question that hasn't been answered in my mind.
You know, part of the productivity miss is decidedly not been answered. We'll again have good conversation on all this in economics, finance, and investment. Coming up, we will turn to the pandemic. The numbers are fascinating, cutting both ways. There's clearly better news out there, but also some really, really distressing trends internationally.
Did you see what happened with China?
As well.
China's
Remind me on China.
Well, they're doing more of the lockdown type of behavior because of an uptick in infections, raising questions about the vaccinations and the effectiveness with the Delta variant.
And the numbers out of Latin America are just flat out grim. So it's a really nuanced picture right now. Nuanced as well as the market. Red and green on the screen. NASDAQ a little light here off of 2 good days. Futures up 3, Dow futures up 83. And the VIX, I'm going to call it in-betweeny, 17.75. Least to the 4 digits watching the 10-year 1.5009. Please stay with us. Matt Miller in for John Farrell. Lisa Abramowitz, I'm Tom Keene. Stay with us. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Commerce ministers from the US and China have agreed to move forward on trade and investment ties. The two held their first call since the start of the Biden administration. Some parts of US policy towards China are becoming clearer. Still, it's not certain what the US plans to do with the Phase 1 trade deal signed last year or with tariffs on Chinese goods. Banks will face the toughest capital requirements for holdings in Bitcoin and other crypto assets. That's under global regulators' plans to ward off threats to financial stability. Democratic Senator Elizabeth Warren told Bloomberg TV the U.S. government needs to step up the oversight of the cryptocurrency market.
Banks either holding Bitcoin, that becomes an issue that we need to talk about with the bank regulators. So there are a lot of different pieces to this, and I think the answer that we saw today is that right now our regulators and frankly our Congress is an hour late and $1 short, and we need to catch up with where these cryptocurrencies are going.
Warren also says the amount of energy needed to power the Bitcoin network threatens the environment. The 16-year battle to build the Keystone oil pipeline is dead. Canada's TC Energy has dropped the controversial cross-border project. It became a litmus test for climate activism and was blocked by President Biden. Keystone was designed to ferry more than 800,000 barrels of Canadian oil sands crude a day from Alberta to Nebraska. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may
be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is the time to make relatively small investments in health, particularly to prevent the effect of this disease. And the impact on societies and economies is huge. And I really think that we need to think about that return on that investment versus worrying about what that investment is.
Good morning, everyone. Bloomberg Surveillance. Jonathan Farrow, Lisa Bramwitz, and Tom Keene. Matthew Miller in for Jonathan Farrow in this hour. The gentleman from Moderna there, of course, with the huge success, speaking with Ian Brummer's group, G0 Media, there on healthcare after this pandemic. A number of currents out there right now, and we address that. We do this, on this huge news flow day. We're going to address that right now with Jennifer Nuzzo of Johns Hopkins Center for Health Security. Jennifer, I need you to come to the rescue of the gentleman from Holy Cross. Dr. Fauci is having a difficult week, and he says, follow the science. That's been the huge message of the last 24 hours from a beleaguered Fauci. Frame for us right now what that means to the critics of people like you, the critics of all the guests we've had on science, and obviously we're very pro-science. What does that phrase mean to you? Follow the science.
For me, it means the data should just drive our decisions and the policies that we implement. It doesn't mean that we have unwavering faith in the decisions being made, but we very much have to look at the data, examine the data, and let the data tell us where to go. Unfortunately, it's really interesting to hear that this week, because what we're seeing in the U.S. is that a lot of states are really scaling back on their data. They're reducing the frequency that they're publishing COVID-related data. I know that everybody feels like we're on the home stretch, and we are, but now's not the time to scale back. We very much need the data in front of us to make sure we're on the right path and make sure that we don't quit before the game is over.
Yeah, well, we're on the home stretch in the U.S. and maybe in Europe, but once again, we had a record number of deaths in India. The G7 planning to do something about it. They want to donate 1 billion shots to those in need through 2022. Is that enough? Everyone just getting out there and donating shots in the near future?
Well, it's absolutely critical. There's no alternative. If any of us want to put this pandemic behind us, it's absolutely essential that we do that. And we need to do that as quickly as possible. I'm really heartened to hear of these plans, but the ultimate impact will be judged by how quickly we can get them into arms, because this pandemic continues to rage. It continues to cause staggering numbers of cases and deaths. And really, time is the enemy here. So we need to move very quickly.
Is it not even more important, Dr. Nuzzo, as we see these scary new variants coming, for example, out of places like the UK and threatening to roll back our reopening plans? You know, the longer we wait, do we see more variants?
Yeah, absolutely. The more infections, the more possibility for mutations, and the more, you know, the possibility is that some of these mutations could do things that we don't want them to do with respect to the ability of the virus to respond to the vaccine or evade the vaccine. So it is really essential that we get vaccines into arms as quickly as possible. That's in every country's pragmatic best interest. I was really heartened to hear yesterday President Biden suggest that there'll be plans to purchase additional doses, staggering number of doses, still, a drop in the bucket in terms of what we need globally, but really one of the largest potential pledges of vaccines to date. Really important. And frankly, it is, in our selfish best interest to do this.
Jennifer, thank you so much. Jennifer Nuzzo there with Johns Hopkins today on the pandemic. This gives us a window right now and an incredibly busy day to dip into where we are. In Lisa Brammett's, to me, where we are, this compendium of issues we have all centers around economic growth. The Deutsche Bank article that we saw earlier with Peter Hooper centers on continued growth. Jan Hatzius's blistering note last night on inflation, it is transitory, centered on economic growth. He sees a lesser growth, a more tepid growth out in Q4. I mean, it's the parlor game of the moment. What will we be doing in 100 days?
And when we talk about growth, there's also the question of how this directs Washington's policies. We heard about bipartisan talks breaking down. Now we've got a new Republican infrastructure bill that includes no tax hikes, which has been one of the big pushbacks, that basically the tax hikes that Biden has proposed would stymie potential growth. Tom, the key question that I have is, as Peter Hooper was saying, we've entered a new paradigm where people don't seem to care about debt sustainability in the same kind of way that they used to. How does that inform policy going forward? Who are the hawks left? And how do we sort of prioritize growth without potentially raising some fiscal stability problems down the line?
And this hawk idea, folks, is not to be it. I mean, it's been the dovish of all times in our lives. Some would say dovish as far back as 1947. Matt Miller, give us an update on the mother of all hawks, which is the central bank of the Republic of Germany. I mean, where's the Bundesbank fit in to Madame Lagarde's morning?
Yeah, even the Bundesbank is bending a little bit, not as hawkish as they've been in the past, but they still, in a sense, I always think it's funny that, U.S. Democrats would be CDU. They'd be on the center right here. Well, the German hawks are far more hawkish than the most hawkish Americans. I mean, we've had this black zero program in place. The Germans don't want to incur new debt, but this pandemic has forced their hand.
I mean, what's so important here, folks, is to look at the clock, look at the news flows out there, noting that Matt Miller is going to waltz on with his Germanic day. And that means it is time for obligatory car talk with Matt Miller. Matt, how are electric vehicles doing in Germany? And are they going to buy the F-150 electric vehicle pickup truck?
I wish. I always wondered. Alan Mulally would say they had a one Ford policy. They made one product for the globe, and they don't sell the pickup trucks here. Before I moved back, Tom, I thought about bringing my F-150 Raptor with me, and now I realize it would be impossible to fit through the streets. The streets are just too narrow here for American pickup trucks.
Lisa, look at the enthusiasm we get from Miller with obligatory Miller car talk.
The only way to incur more enthusiasm from Matt Miller,
it's just great,
is to say Bitcoin. Go. No, honestly,
that's unfair.
Honestly, Bitcoin today, I have to go there. It's rallying a bit, which is interesting to me because it's coming in tandem with some comments from the Congress, from Senator Warren in particular, saying that she would like to see more regulation around Bitcoin. And also,
is that a surprise, Lisa? Is that a surprise?
Well, maybe not. Okay, fair point. Which is a reason why
the real news around Bitcoin. The real news around Bitcoin, and Joe Weisenthal the other day wrote a great column saying it's not a currency,
it's a
because
commodity.
No country, no government requires you to accept Bitcoin, but now that's no longer the case. El Salvador will take payment of taxes in Bitcoin and requires merchants to take it as legal tender.
So maybe tomorrow we'll do obligatory Miller Bitcoin talk. That'll be just as good as well. Matt Miller, have a good day. Thank you so much for joining us here on Surveillance. I believe, I'm not sure, Romaine Bostic, I believe, was seen. I thought I heard the Sikorsky just above Home Depot as well. Coming up on this moment for economics, finance, and investment, Ben Emmons with us from Medley Global Advisors, and from Cornwall with the president, Guy Johnson. Johnson meets Biden. Stay with us. This is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America. BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
market is becoming more concentrated and less contestable.
Right now, people are focusing on low-quality stocks, whether they're meme or not.
We actually think the markets tread water for a bit as we continue to be concerned about inflation and taper talk.
We have a real recovery in process. I don't think the roaring 20s are the right analogy.
Well, I think inflation is going to run. That's a good sign. That is a economy getting back on track.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television, a simulcast, an exceptionally busy Thursday. No other way to put it as well. Romaine Bostikin for John Farrow this morning. And yes, we will do memes. People emailing in, get Romaine on to give us the meme
that's why I'm here.
update.
Yeah.
Right now, Lisa, I want to go to the major news item out of Cornwall, which is out of the Times of London today, a démarche where the U.S. did a formal statement to the United Kingdom about a week ago, really concerned about Northern Ireland, EU, the Republic of Ireland, and such. Our Jennifer Jacobs reports within the last, I'm going to say 3 hours, disputing the report in the Times of London. Jennifer Jacobs, and I quote, the official said the United States isn't planning to issue any diplomatic rebuke to the United Kingdom over Northern Ireland. Lisa Abramowitz, that's a hell of a way to start a Thursday in Cornwall.
Well, especially considering the fact that President Biden was hoping to repair relations with the closest allies, including in the forefront, the United Kingdom, where he is meeting with Boris Johnson. So it would be a surprise for him to come out with some sort of major rebuke today ahead of those negotiations. Yeah. That said, still so many tensions underpinning these meetings, and that cannot be understated here, or overstated rather, Tom, because honestly, even post-Trump, there are some remaining tensions.
And lots of hearkening back. A new Atlantic charter is a schedule here. The weather's inclement in Cornwall. I'm not sure they're going to get in front of the Prince of Wales, the military pride of the United Kingdom, for a signing of a new Atlantic charter. Probably in there is a paragraph on our markets, because away from inflation, jobs, we need a meme update right now. Romaine, yesterday was insane.
Yesterday was insane, and we keep talking about this rotation from one meme stock to another. You had Context Logic, you had Clean Energy, you had a lot of stocks that no one was really paying attention to. Cleveland Cliffs, which is sort of an old economy company, actually sort of briefly became a meme stock yesterday for some reason. Look, the rotation continues. This morning here, some of that volatility, some of that volume is a little bit tamped down today. I think right now you are seeing a little bit of a holding pattern overall across the markets, of course, as we wait for 8:30 a.m. here, New York time.
You know, Romaine, look, besides the shock of the Chicago White Sox playing 607 baseball, the other shock is Gary Gensler hasn't weighed in. Did the chairman of the Securities and Exchange Commission change his tune yesterday? Has he weighed in to derail the roulette of the meme stocks?
Well, we've seen him on interviews on other properties that aren't part of Bloomberg. And I mean, look, they've made it clear that some sort of regulation or some sort of crackdown is coming. It's not really clear what that crackdown is or what it even can be. Remember, late last night, we had GameStop release its earnings and its 10Q, and it did provide a disclosure saying that the SEC staff had actually requested documents about its trading activity, primarily around that surge that we saw back in December and January. It was kind of vague as to exactly what was being requested, Lisa, but the fact that the SEC staff is now into this, I think should give a lot of people a little bit of pause.
Romaine, there's another GameStop news item from yesterday that I thought was fascinating. They're going to sell potentially millions of new shares. And this is fascinating because they're actually trying to de-memify themselves, actually take the incredible rally that they've seen in markets and use it. This is smart, actually raise more money so that they can try to update their business model to the Amazon era. And this is the question, can this rally actually have some fundamental purpose beyond just a parlor game?
Of course, and it already has, Lisa. I mean, how many of these meme stocks we talk about were either bankruptcy cases or certainly at least you had to talk about the potential of them maybe going bankrupt during the pandemic, and a lot of them have basically been saved by this run-up in the share price. They've used that to deleverage their balance sheets, and they're in a healthier position. There's still maybe a longer-term case you can make that maybe their business model isn't necessarily going to carry them much further, but at least for right now, they're in a much better position today than they were 6 months ago, 9 months ago.
So, campers, what's our key takeaway from this discussion as we move forward to the data check? And it is the pendulum of dememification.
It's back.
Abramowitz on dememification as well.
Right,
futures
campers.
up 2, Dow futures up 71. The VIX comes in 17.79. Lisa and I glued to a 1.50 10-year yield. Of course, important inflation data coming out, and with that, the jobs report as well. I think there's a briefing out there somewhere.
Oh,
Where
right.
is it,
And
Lisa?
he's going to keep singing until we get it. 7:45 a.m. we get the ECB rate decision. 8:30 a.m. Christine Lagarde's going to come out, and what everyone is looking for is whether the ECB is talking about tapering or even planning to taper their monthly purchases of bonds. Right now, the market seems to be shrugging off suggestions of that. 8:30 a.m. we get a slew of economic data out of the United States. CPI, this is the big one for the month of May. Consumer prices expected to rise the fastest pace going back to 2008. Nobody cares. If you take a look at Treasury yields, people shrugging it off. Transitory, drink, they are expecting it to be just that. And then we're also going to be getting jobless claims. I might actually, unless the numbers are as noisy as they have been, might be watching jobs more than anything, because perhaps that has a longer lasting effect on inflation if you look at the stickiness of wages when it comes to those equations. And then 2 p.m., Treasury Secretary Janet Yellen talking about the budget as well as her views on the CPI print. She'll be, I'm sure, talking about inflation. She's been talking about the importance of doubling down on the low rate regime for a longer period of time. She also has been pretty vocal with her support of the global minimum tax rate. And that, I think, is also going to be interesting to see how she plays that in terms of U.S. competitiveness and attracting U.S. corporations.
I'm glad you bring that up, Lisa, because we really haven't touched on it this morning. All of a sudden, there's pushback. They want an exemption for the city in London. I think they want an exemption for the Upper West Side, Lisa.
Oh, yeah, very much so. Did you read? There was actually a really interesting op-ed in the Washington Post penned by 5 different finance ministers.
Mr. Geithner and the others.
Including Janet Yellen, where she basically was saying that the pandemic accelerated the wealth gap, that countries have been stripped of their sovereignty when it comes to tax policy due to the competitiveness, and why it's important for this global minimum tax rate.
Yeah, I misspoke there, folks. There's been 2 separate essays, one by Treasury secretaries, including Secretary Geithner, and also the one Lisa alludes to with Janet Yellen and other finance ministers. Again, futures flat right now. Watching here an hour and a half away, the inflation data. Ben Emmons joins us right now with Medley Global Advisors. Very good, really thoughtful essays here, linking all this together. Ben, the Folkerts-Landau essay for Deutsche Bank is a bombshell. They speak of the time bomb of inflation. Do you fear the regime change, or to use a phrase from Abramowitz, the paradigmatic shift back to Reagan-Volcker inflation that they allude to?
I understand where it comes from. We are coming out of a pandemic, and you have this shock on the price level because, when you shut off an economy and you are essentially in a deep deflation territory, you get that base effect, and we still see coming that through, including today. But when you get through that fog, I do think that the inflation rate itself probably tempers, and that's what the market also has been pricing in, so to speak. It's in the assumption of the inflation-linked bond market. I think that's rational, because if you do get to a reopening that's full and all services are available again, you get competition and you get more and more people coming onto the marketplace. So I think in the United States economy, we'll probably get some moderation of this, other than that you have ongoing effect from commodity prices on inflation. And that too, by the way, can moderate inflation over time as people just make changes in their consumption pattern if gas prices are too high.
Yeah, and Ben, probably the phrase of the month is capitulation. We've seen capitulation of all the people trying to short treasuries here ahead of inflation rates that are expected to be fairly high. Have we seen full capitulation, or is there more to go?
Great question, Lisa, because we're right maybe at this point there that, at 1.5% Treasury yield, for where the economy perhaps is currently, that's really dislocated. I would think, like, just in nominal GDP terms, rates are just way too low, but we are here because I think the market has judged that as you are coming online completely, you're going to have to sell out of the new trend. Is that trend 2019 pre-pandemic or not? And I think the market is struggling with this. So, and then you have all this technical positioning around it. So it could indeed see, ironically, yields lower from here. instead of higher, and that's extraordinary from where we come from.
But is there anything about the trend line that we've been seeing in the economic data, particularly with some of the price indicators here, not just the CPI, but of course the PCE and some of the other indicators here, Ben, that would actually change some of the calculus, change some of the theses out there about what the Fed's going to do next?
Well, there's again that message that we have to confront each time with these numbers, right? If you think about payrolls number, it's about talking to talk, and if you think about inflation, it's about thinking to think. But we are still in the stage of trying to start talking, and therefore inflation, although it can surprise and can affect yields, I'm not going to discount that possibility. At the same time, I think the market, particularly the bond market, is focused on this labor picture, and we know it's 8.5 million. Unemployed, and that's going to take a time to work off. I think that's where most people side at this point, to see that materially change, unlike the inflation picture, which, okay, it can affect markets today, but it may then be taken back, seeing, okay, inflation can also slow down activity over time.
Ben Amos, thank you so much. Too short a visit today with Mentally Global Advisors. I look at this as a stew, Lisa. I just really don't know what to make of it. It's not our job to give an opinion on all this, but boy, the mystery going into 8:30 is extraordinary.
If markets are right, though, right, and we are going to go back to a low inflationary environment after this blip upward, what does that say long term about being able to print money, modern monetary theory, the idea of fiscal and monetary expansion at the same time? This, to me, is the biggest question. That means it doesn't matter, debt sustainability for the developed markets.
And it's an oddity, Romaine, that rolls right over to the equity market. I mean, it's not that there's an uncertainty, Romaine, there's a set of uncertainties, huge mystery.
There's a set of uncertainties, and there's a structural change in the market and sort of what's driving the market right now. And a lot of people are sort of trying to use old models from previous economic cycles, previous market cycles, and apply them to something now that is just unprecedented, and it just doesn't work, Tom.
Well, we're going to have to see, and of course we'll drive this through the afternoon as well. We do this with this equity market right near record highs. I believe some of the international series yesterday actually went out on good international performance. 2 record highs as well. Under 150 again to 4 digits. The 10-year yield, 149.75. That is something. On radio and television, this is Bloomberg. Stay with us.
With the First Word News, I'm Ritika Gupta. The US and China have agreed to push forward trade and investment links. That came out of the first call between commerce ministers from the two countries since the start of the Biden administration. It's still not publicly clear what the US plans to do with the Phase 1 trade deal signed last year or tariffs on Chinese goods. The U.S. plans to buy 500 million doses of Pfizer's coronavirus vaccine to share internationally. The word came as President Biden prepared to join another group of 7 leaders in a campaign to end the pandemic by distributing shots worldwide. The G7 leaders have gathered for their summit in the UK. Meanwhile, G7 leaders are discussing plans to shift the balance of car buying away from gasoline to greener vehicles by the end of the decade. It's part of a package of measures to combat climate change. According to one document seen by Bloomberg, governments would, quote, strive to make sure that most new passenger car sales are green-powered by 2030. And the world's food import bill is expected to climb to an all-time high this year. Poor nations will be especially hard hit by the soaring cost of staples. According to the UN's Food and Agriculture Organization, developing countries face a 21% jump in the total bill. Richest nations will pay 6% more. The increase is led by higher prices for grains, vegetable oils, and oilseeds. Bloomberg has learned that United Airlines is in advanced talks to buy at least 100 Boeing 737 MAX jetliners. It would be part of a broader fleet revamp. United sees it as a chance to upgrade at a time when Boeing and Airbus are hungry for deals. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The EU's approach is clear. China is a partner, a competitor, and a potential systemic rival. We will defend ourselves against practices that pose security risks, distort the level playing field, or are incompatible with our values.
Charles Michel there for the European Council and their president on China. One of the backstories here in our international relations in Cornwall. We welcome all of you right now to Bloomberg Surveillance on radio and television. Romaine Bostick for Jonathan Ferro, Lisa Abramowitz, and Tom Keene. And we could do like literally a 6 or 9 hour show. Today, the news flow is extraordinary. We've covered Bitcoin, we've covered the meme stocks, and then there's the real stuff like ECB meeting, and we've got these inflation and jobs data.
Romaine's actually doing a full 9 or 10 hours, I think.
Yeah, that's just another day in the life for me, Tom.
Yeah, it's called the marathon. No more greater marathon right now with futures up 3. For our Josh Wingrove, our Bloomberg White House correspondent, he is in Cornwall, and we're thrilled that he could join us this morning as well. Josh, we're going to have a new Atlantic charter this morning, hearkening back to the myth and history and the reality of 1941, I should say. What does the president want out of a new Atlantic charter with the United Kingdom?
Well, I think first and foremost, and good morning, he wants to be seen to have a new Atlantic charter with the United Kingdom. Biden's sort of MO on this trip is to show that he's very close to European allies. Of course, this is in the build-up to then the NATO summit and then that Putin meeting. And so, you know, the event itself is a big part of the ball game for him. The relationship between the U.S. and the UK, of course, was a little bumpy these last few years. But even on the UK side, terms like special relationship don't really fly as much here as they used to. So, you know, Biden is going to look to sort of mend, I guess, those fences. And so far, you might have seen, of course, the press in the UK are in a tizzy over Biden's views on Brexit, in particular, the Good Friday Agreement and the Irish border.
We covered that in the last hour on the Irish border and this demarche again. Our Jennifer Jacobs reporting that the British press is off the mark. There has not been a formal document by the U.S. State Department chastising the United Kingdom on Northern Ireland. But Josh Wingrove, maybe there will be a demarche about China as well. Are the Prime Minister and the President on the same page on China?
I think the UK Prime Minister and the U.S. President are, I think once the G7 itself kicks off here tomorrow, it's going to be a little more mixed. Angela Merkel and Emmanuel Macron have both taken a little less of a hawkish stance, but Biden wants the Europeans to support in positioning China as the chief U.S. sort of rival. In particular, he's seeking support on a call to investigate the origins of COVID-19. We don't really know how far the G7 will go in that, but you know, Biden is trying to show this show of unity, but if you pull back the curtain a little bit, there are tensions here. I mean, the U.S. still has steel tariffs in place. You've got the Airbus dispute is ongoing. There's the Nord Stream 2 pipeline, of course, which Biden wants, but is sort of thrown in the towel on trying to stop. Excuse me, Biden doesn't want, but it's thrown in the towel on trying to stop it. You know, there are. It's not all chummy here, but they want it to at least look a little bit chummy.
Yeah,
so today, that bilat will be the big key part of it.
Yeah, we're going to be talking about the pendulum of chummy for the rest of the day. Thanks a lot, Josh. There is a question, though, about how much chummy there is around the tax proposal, the idea that there's going to be a global minimum tax rate that was agreed upon. How much momentum is there in this G7 meeting for that?
I think in the G7 there's a lot of momentum. There's a question of whether there's momentum in Congress back home, and then outside the G7 among other nations. I think that is a big question, but it was a big deliverable for Biden and for other countries that have been advocating for this. Of course, the U.S. backdrop is, what does that mean for these infrastructure talks? Biden has, of course, shifted from Senator Capito to this other group of senators. Will they, want to do something, either the 28% corporate tax or the 15% floor as a corporate tax rate, minimum corporate tax? We asked Jen Psaki, the White House press secretary, that on a plane ride over yesterday, and she said, look, it's all up in the air right now. Biden still wants these things. This is sausage making. We're going to see how it goes, but they're clearly, not imminently running the corner on this sort of thing.
Josh, I know there's a lot of focus right now between Biden and Johnson, the U.S. and the U.K. here, but talk to us a little bit about the relationship as well with the other two important nations that are part of this group here, Japan and Canada, two relationships that certainly deteriorated a bit over the previous 4 years. Yeah, the Japanese Prime Minister has already met in person with Joe Biden. He has a telemeeting with the Canadians, so trying to give them a little feather in the cap as well. He wants close ties with both these countries. On the issue of vaccines, I think he might, he won't get an earful per se, but I think if this had been a few weeks ago, he might have. I mean, Japan and Canada and even, Germany, France, and Italy are much farther behind in their vaccination campaigns than the U.S. and the U.K. The U.S. and the U.K. really gobbled up doses early. They sort of, made it difficult, if not impossible, for other countries to get their hands on doses made in their soil, at least in large numbers. So the U.S. and the U.K. are here to sort of announce this new phase, this new, benevolent pace of donations. But for the other countries sitting around the table, it's kind of 4 months too late, and they're not so keen to give them a pat on the back for their altruism here.
Josh Wingrove, thank you so much. Greatly appreciated from Cornwall this morning, traveling with the President of the United States. Romaine, there it is. Kristen Flanagan reporting. This is really important, folks. It's done a double in 2 cups of coffee. It was up as high as 164%. And Romaine, the sell side dashes to a sell rating on Clover Health. Bank of America out with the first sell rating on Clover Health. Yeah. I mean, you got to, right? Your lawyers, general counsel's going, let's go.
Well, you have to. Not only have you seen downgrades in some of these meme stocks, I think it's funny, or interesting, I should say, how many sell-side analysts have actually abandoned coverage of some of these because they're basically divorced from any sort of traditional modeling. And if you're an analyst, and I guess you have whatever duty you have to your clients here, it's hard to really make any sort of model that's going to work.
Lisa, what'd you learn from Gary Gensler? I thought his comments buried in the news flow were actually pretty important.
Yeah, the idea that they are really looking at regulating some of this retail trading. Again, though,
we're going to look at it.
Who are we regulating? Are we regulating the day traders? Are we regulating the Robin Hoods and the Citadels of the world? Because that seemed to be where a lot of the focus was directed, was at the order flow, not necessarily the individuals, which I suppose politically is a safer bet. But again, I mean, who's being harmed right now? And I think that we will see that play out, certainly, if there is a fundamental reckoning with some of these shares.
I'm going to keep my opinion out of this, but it's free. It's like Romaine, it's free to be chummy.
Is it?
It's free.
Well, but is it?
But
you ply me with Tang mimosas. See, no, but it's not free, right? I mean, that's the ultimate thing, right, Romaine?
Well, it's not free. I mean, we talk obviously what the actual traders pay. Of course, is technically free on the top level.
Oh, don't get me going, Romaine.
Well, but look, I mean, we've seen this. We've been here for a while now. I mean, there's basically been low commissions or no commissions for quite some time now. What's changed now? What's changed now, Tom, in the past couple of years?
The order flow guys, Romaine, they live like 3 floors below you. I mean, these guys are buying up all the real estate in New York.
I don't live like that.
Stay with us. It's Bloomberg Surveillance from New York and from Cornwall.
From Cornwall.
Europe's financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacwan. We'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television.
Surveillance. We welcome all of you worldwide and across this nation on radio and television. A most eventful day. Later today, the President of the United States and the Prime Minister of the United Kingdom to sign a new Atlantic Charter. We'll have that coverage for you in, I believe, the 10 o'clock hour, Wall Street East Coast time as well. What we also have as well, we're going to have a market open today. We need to figure out which stock is going to go up 1,000%. Lisa and Bramowitz and I wait for the Bostic report. Here's Romain Bostic.
All right, well, here's the Bostic report here for you, Tom, here. In the pre-market, it's a little bit light here today. Maybe that's some folks waiting for that 830 inflation number. Yeah. But right now, when you look at what's moving, a few stocks that are moving on actual fundamentals. Boeing shares getting a little bit of a bid here. 100 orders from United Airlines, according to people familiar with the matter. Bloomberg is reporting that this would be a big boost for the 737 MAX. Of course, Boeing trying to get that sort of project back on track here, of course, after those incredible delays, after those two fatal crashes here. Keep an eye, of course, on GameStop. Of course, a big talk about the meme stock. They had those earnings last night. The earnings themselves obviously didn't matter as much, but they did have two interesting hires from Amazon. Remember, Ryan Cohen has really been opening up the checkbook, luring a lot of folks from some of these bigger companies to come over and really try to position this company for whatever this e-commerce strategy is going to be, a strategy that he still hasn't fully articulated, but investors seem to be on board with it. The concern here, though, with the shares down in the pre-market is the disclosure here of an SEC staff inquiry into some of the trading activity in GameStop shares. We'll see whether that turns out to be something material. And then keep an eye on RH. They actually reported earnings. I'm sure you're familiar with this. This is the company formerly known as Restoration Hardware. They make a lot of that big, bulky furniture, Tom, that you use to sort of stock your mansion there overlooking the Palisades. Getting a nice little bid here, up to 665 here in the pre-market. There's still a lot of strength there with regards to folks buying that furniture. And you flip up the board here, and you're seeing that strength reflected in a lot of other retail stocks as well. Signet Jewelers getting a nice little bid as well. People still sort of gravitating to that side of the retail equation. Those shares up about 7% here in the pre-market. And two events to keep an eye on. First is Grubhub. Remember the voting on that Grubhub acquisition, the acquisition of Grubhub by Just Eat Takeaway. The deadline for that is today. CalSTRS and a lot of the other big pension funds and hedge funds are on board with this. Those shares slightly higher here in the pre-market. And Tesla going to have that Plaid event that a lot of people have been waiting for. This is the faster version of the Model S. That's supposed to roll out today, but sort of the sizzle that you would normally get from these Tesla events, not necessarily there today. Those shares only up fractionally, still camped out right around that $600 mark where it's been now for the past couple of weeks.
Roy Bostic, Sharp, thank you so much. And again, those equities, the equities away from the memes, the de-memed up near record highs on so many different indices. This is very important. Research notes come in, and sometimes they really jump out. And this is on market economics and the present worry about inflation. Eric Nelson of Wells Fargo is focused on Goldilocks. Here's the text. Once upon a time, there was a little girl. Her name was Goldilocks. She had dark brown hair from the Upper West Side and worried about the pendulum of gloom. One day, Goldilocks was walking in the forest of inflation. She saw a house that knocked on the door. She went inside.
This is amazing.
No one was there.
Amazing.
Lisa, why don't you bring in Eric Nelson on Goldilocks?
You don't get this on Bloomberg.
This is just gold. I will say. This is what. How long did it take you to write that, Tom?
I
That's fantastic.
Yeah. Well.
All right. Well, we're
Goldilocks of inflation. That's what we're. That's
the
what
Goldilocks
you are.
of surveillance. Eric Nelson, come save us, Wells Fargo strategist. I'm sure you regret writing Goldilocks ever and won't do it again in your reports. There is a question about the CPI data, but before we get there, I want to ask you about the message being sent by the bond market. Can we actually get any message from Treasury yields, given the fact that the Federal Reserve is in there buying $120 billion a month, and the fact that there have been other international reasons that this yield is skewed?
Absolutely, I do believe you can, Lisa. The Fed is surely taking down a substantial amount of coupon issuance this year, but you have to remember, there's much more coupon issuance this year than there was last year. And Fed buying as fast as it is a lot slower than it was last year. So the Fed is not nearly absorbing all of the coupon issuance that's coming out this year. So in terms of the actual signal from bond yields, I think we had a massive adjustment earlier in the year. Markets probably got a little bit ahead of themselves.
Yeah.
And now we're seeing a little bit of a pullback as positions get squared. But we're talking about 7% U.S. GDP growth this year and 6% growth next year. These are huge numbers. This is not just a one-off this year.
But Eric, the reason why I ask this is because people look at the bond market and they say that it justifies the Fed's view that they can stay on hold, that all of the data that we're going to be getting is transitory. But is that really what it's saying? How do we know it's not saying that the market thinks that the Fed is going to absolutely jump on the inflation, reverse course, and hike rates more quickly, which will lower inflation down the road? I mean, what is the message that the Treasury market's actually sending?
Well, there's various messages coming from this, and you have to think about for the foreign investor's perspective. You look at the cost of funding in the U.S. dollar market. It's extremely cheap to source dollars right now. So we talk to foreign investors who want to pile into some of these FX-adjusted yields at the long end of the U.S. curve. So it's not just about growth, inflation fundamentals, what the Fed's doing. You also have to think about it from an investor's perspective. And for the time being, that's likely to keep the yield increases in check, even if we continue to see pretty strong inflation prints over the next few months.
Eric, this raises a question about Goldilocks, going back to the fairy tale that Tom was telling, which was absolutely beautiful. It brought tears to my eyes. I will tell it to my children tonight. There is a question about the ramifications to Goldilocks. If you are correct, and regardless of fundamentals, you're going to get this bid into treasuries internationally and for other reasons, what does that mean about risk appetite, how far it can go, and the potential financial stability issues that arise therein?
Well, what's been so interesting, Lisa, is to see the pockets of volatility and the pockets of pullback in some of these risk appetite areas. So, while we're seeing relative stability in, say, the broad indices and, some of the broad treasury market, you are seeing a lot of nuanced moves in certainly some of the meme stocks, but also some of these areas earlier in the year. Some of maybe the clean energy names that were so strong and have seen pullback. So I would suspect the Fed is welcoming this relatively nuanced volatility that it's seeing, as opposed to just continued unabated risk appetite in the equity market.
Well, but some of that nuance right now, to borrow the Fed's own phrase here, some of that nuance also seems like it could be transitory here, Eric. We've seen a market here that sort of readjusts and reassesses, and then, of course, it's off to the races very quickly here once they feel like they've gotten whatever sort of green light out of the Fed that they think they may get. Any sense here that the economic data that we get over the next, not only today, but really over the next few weeks here, would actually change anyone's mind?
Well, Romain, the CPI data to me are incredibly noisy right now, and I suspect the Fed will look through the CPI data for the next several months. Personally, I believe the Fed is much more focused on employment data, and particularly in wages. So we've obviously had two kind of dud employment reports the past 2 months, which supports the Fed's case for being patient on tapering. We don't think the Fed's going to start tapering until Q1 of next year. You'd have to see a big acceleration both in job growth and wage growth, particularly in the ECI numbers, not the average hourly earnings numbers, to see the Fed knocked off course.
Yeah, but Eric, what's fascinating to me, and I get all the fancy market talk, guys like you and economists, strategists of all flavors out there looking at this cool, calm, and collected. The American public won't. And, to go to Goldilocks again, somebody's going to wake up and go, someone's been giving me inflation. That's going to be the response, even if it's transitory. Can that derail the clear thinking of the Fed?
What matters, Tom, is how long does this last? My father's a home builder. I had this conversation with him all the time, and I can hear him squirm through the phone when I tell him this is all going to be transitory. So if you tell me 1, 2, 3 years down the road that we're still looking at massive increases in lumber prices, used car prices, and this is starting to seep through into wage negotiations, then yes, I'm worried. But this is not the first time we've had periods of short-term inflation where consumer expectations rise and then quickly pull back within a year or two. So it's all about the durability of this process.
Eric Nelson, thank you so much. Greatly appreciate it. With Wells Fargo, not to be confused with Dr. Nielsen over at Unicredit. We got Nielsen, Nelson, and all that. We've had some confusion over that. Again, we welcome all of you here to an extremely busy date calendar. Lisa, let me go to you on ECB. I think we've underplayed it with our bias to New York. Matt Miller helping us out from Berlin in the 6 o'clock. More up to speed on that. Young Pharaoh is more up to speed on it always than we are. What's your take on ECB other than the camera shot to the multiple podia of Madame Lagarde is way too far away?
The complacency among both traders and the ECB that they can continue their bond purchases at the continued pace. We had been talking about tapering more aggressively at the ECB, even than the Federal Reserve. There seems to be some backing away from that. The question I have is how much dissent is there? So far, it seems like there's a lot of agreement among ECB members to keep going with their policy as is. However, do you start to get disagreements? Do you get worries about froth? Do you get worries about other considerations?
Yeah, Romain, what's so interesting here is the corporate world just ignores it. I mean, I get they're attuned to it, and they've got advisors who are attuned to all that we're talking about. Yeah. But the answer is revenue growth is there wrapped around this GDP.
Yeah, and I think one thing I'm really interested in is to see the sort of the synchronization or lack of synchronization that we start to see in central bank normalization, particularly given that the Fed's mandate now is very divergent from what the ECB's mandate is. And so when we look at the inflation numbers, we have to sort of separate what's happening here in the U.S. with inflation and what's happening over there in Europe and how that feeds into these policy decisions.
I'm so glad you brought this up, Romain. Lisa, I thought Kit Jukes was absolutely brilliant this morning at Societe Generale, and he alluded to just what Romain said, which is this idea that the U.S. will act and the others will follow. That's the assumption.
And what we got a little bit of noise of earlier was the sense that perhaps other central banks were ready to move faster than the Federal Reserve, which was an uncomfortable reality. Are we going to shift back to the Fed moving first and then everybody else following? Who's on first? Who wants to move first? I mean, this is a currency issue.
I'm not doing who's on first. We're not doing Abbott and Costello here.
We're doing another poem.
I'm not doing Abbott and Costello into ECB. I'm just not doing it.
Yeah, I think that's what we're going to be
Futures
doing.
negative 4. Stay with us. An exceptional news flow on radio and television. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. Banks will face the toughest capital requirements for holdings in Bitcoin and other crypto assets. That's under global regulators' plans to ward off threats to financial stability. Democratic Senator Elizabeth Warren told Bloomberg TV the U.S. government needs to step up oversight of the cryptocurrency market.
Banks either holding Bitcoin, that becomes an issue that we need to talk about with the bank regulators. So there are a lot of different pieces to this, and I think the answer that we saw today is that right now our regulators and frankly our Congress is an hour late and a dollar short, and we need to catch up with where these cryptocurrencies are going.
Warren also says the amount of energy needed to power the Bitcoin network threatens the environment. Commerce ministers from the U.S. and China have agreed to move forward on trade and investment ties. The two held their first call since the start of the Biden administration. Some parts of U.S. policy towards China are becoming clearer. Still, it's not certain what the U.S. plans to do with the Phase 1 trade deal signed last year or with those tariffs on Chinese goods. President Biden and British Prime Minister Boris Johnson will commit today to resume travel between the two countries as soon as possible. It's not clear how soon that really will be. The two leaders are meeting ahead of the start of the G7 summit. They'll launch a joint task force to explore travel options. And in the UK, antitrust regulators reportedly are looking into how Amazon uses data from smaller sellers on its site. According to the Financial Times, the Competition and Markets Authority may focus on whether Amazon favors merchants that use its logistics and delivery services. Amazon not commenting on the investigation. Global news 24 hours a day on air and on Bloomberg. Quick take, I'm Ritika Gupta. This is Bloomberg.
Surveillance, Jonathan Farrell, Romaine Bostic in for John today, Lisa Bramwitz and Tom Keene. An exceptional news flow today. All of it, Lisa Bramwitz, centered around 1.4992. And in the Europe, I've seen rates come in there as well. The Swiss 20-year note, just as one example of a different interest rate regime into the ECB decision.
Yeah, well, remember last month, the 10-year yield in Germany was moving towards zero. And now we're going back down below zero as a number of ECB members came out and said, don't worry, we got your back. And that seems to be the theme.
Yeah, absolutely. Yeah, go ahead, Tom.
Well, let me pick up on a little bit of other data here. Brent crude, not 73, 72.38 as well. Red and green on the equity screen. A little bit of sogginess, I would say, to the equity tape. It is a meeting of the European Central Bank with a different mandate than the Fed. Joining us are Michael McKee, looking at the breaking headlines, and we will watch them with Mr. McKee as they stream out here and seek wisdom as well. Mike, we have the headlines coming now, and I'm seeing the word leaves is leading the way.
The first policy decision is out, and it is no change in any of the rates. The main refinance rate stays at zero, the marginal lending facility at 25 basis points, and the deposit rate stays at a negative 50 basis points. No changes were expected, and that is what we got out of it so far. Don't think we're going to get anything really different today. Right. I'm waiting for the policy decision actually to drop, although we have it coming from Europe with the headlines. And it looks like no change in pretty much anything at this point. They're going to keep buying $20 billion a month under the asset purchase program. They're going to keep rates at present or lower levels until their inflation goal is near. And they will reinvest the asset purchase debt for an extended period after raising rates. As far as the pandemic emergency program, runs at least through March of 2022. Is
that important that we got out to March of 22? To me, that's not news.
No, none of this is new. This is what they have been saying for quite some time. Right. They're going to reinvest the maturing PEP bonds at least through end of 2023. The one headline I haven't seen yet and I'm looking for is whether or not they're buying the PEP program at a more significant pace, and that's what I need the release for.
Well, I've got a headline out here, Lisa Bramwitz on PEP to continue to run at a significantly higher pace.
That's what we're looking for. And so basically, there's nothing new in the decisions, and there's nothing new in the statement, at least from what I can see.
He's the height of boredom, Lisa.
Well, no, but this was expected. I think that the height of boredom will come when Christine Lagarde takes the podium. If she fails to say something about talking about tapering, the question here is, at what point do they start to chart out an exit strategy? And is there one? Mike, could we get any guidance around that? Or is the ECB complacent to remain on hold because markets aren't forcing their hands?
I think you called it here, Lisa. There's no reason for them to start talking about an exit strategy. It's possible that Christine Lagarde will mention the idea of talking about, but as long as the markets are where they are, there's nothing necessary for them to do. And they don't really want to turn the markets by getting people more excited about the possibility of changes. And remember, their inflation rate is still running much, much below the United States. Although they're worried about it, they're not expecting it.
Yeah, it's running below the U.S., obviously, Mike. It's also, of course, running below where they would like to see it go. And I think when you start to look at some of these PEP programs and the idea that they are maintaining that pace, if not actually keeping that pace higher for longer, does that give you a sense here right now that maybe when we look to some of the other central banks, i.e. the Fed here, that maybe we'll see a little bit more stasis there as well?
I think you're going to see stasis from the Fed. It's not going to be anything major that changes. It's going to be incrementally small changes in their wording over time because, again, they don't want a taper tantrum, and they learned from 2013 as well. So we may get Jay Powell saying we had a staff presentation on inflation and where we're going, something like that. But you won't see any move from the Fed probably until the end of the year, and any announcement would come then. A lot of talk about the possibility of Jackson Hole, but it really will depend on the economic numbers at the time.
Is this a ballet between Lagarde and Powell? Are they coordinated? She gave a great speech at LSE a million years ago about a square dance. Are they square dancing here?
They're not. They're not square dancing, and they aren't directly related in terms of policy making.
Do they talk to each other?
They do talk to each other. They see each other, every couple months at the Basel meetings. But it's that impact of the recovery in both regions and how it feeds back into the other region that matters. And if you get a lot of inflation in Europe as prices rise and we import those prices, then that affects what the Fed thinks. I am reminded, Todd, when you say that, of the old line about the dancers, and the woman has to do everything the man does, but backwards and in high heels.
I'm not, that's just say, Lisa, help me here. I mean,
nope, not going to help you. Carry on.
Farrell
what you got to say?
Let that hang. Remains being way too. Remains being way
not
too
gonna
polite.
save ya.
Michael McKee, go away. The ECB right now. Katrina Dudley joins us with Franklin, and this is really special. She's got a real ample career on the sell side in securities research and portfolio manager, particularly in Europe with Franklin Mutual. Katrina, good morning to you. How much of a value is Europe right now?
Look, Europe has always been a quintessential value market. You just look at the construct of the market. It's heavy in financials, it's heavy in energy, and they're two sectors that are trading at very, very cheap multiples. But the good news about Europe is actually the construct of the market is changing. We've now got a rising luxury sector, which is the equivalent of the technology sector over here in the United States, and that sector is actually growing.
Whoa. I got to stop. Come on. Are you telling me Louis Vuitton is equivalent to Apple or Amazon?
I think Louis Vuitton is actually even better than an Amazon because it's brand names have been around for many years.
Some people would agree with you.
Exactly, but you can't replace some of their products. You can't get some of their handbags at the moment. And if you've tried ordering, some of their jewelry, it's out of stock. At least.
Mrs. Keene would agree, and
Katrina, this is a long-running story on this show.
Literally, this is the debate.
If you mention Hermes, I'm going to walk off the set.
He
Lisa,
will have,
continue.
nightmares from dinner conversations of yore. Meanwhile, we're talking about the ECB policy in tandem with ECB stocks, and really the underlying question here is there an exit strategy that could be done with grace? In other words, can you buy European stocks for a longer period of time with faith that the ECB can extract themselves easily and gracefully?
Well, I think it's interesting because you were talking about Grace Kelly before in high heels backwards for half the price. If I take a look at the exit out of this, the ECB is watching the Fed. The European markets are actually behind the US in terms of our recovery out of, or actually a recovery from the COVID virus because the vaccine rollout was slower. And so I think they're really looking at the markets, they're looking at the Fed action. And I think that the ECB will be slower to act this time. Just to have a look what happened back in May, where you saw kind of Italian yields blow out, and it was kind of this mini taper tantrum. And I think they're really watching to see what happens because it's not just about what the ECB is saying; it's the implications of that on various markets. For example, in this case, in Italy.
All right. Well, let's talk a little bit about Italy, and I guess the reaction that at least a lot of us on this side of the Atlantic look to when we try to sort of divine what the ECB is going to do and how it's going to be received. How are investors in Italy right now, the investors in Italian debt right now, preparing for whatever it is the ECB may or may not do?
If I take a look, what we're looking at in Italy is support for the new government. I think actually where, I've talked about Italian politics as I say, as messy as a bowl of spaghetti, but I think it's actually at this time, it's probably the best outlook for Italy we've had in a long time. Yeah. And I think the ECB is aware of that. They need to be accommodated.
I mean, Katrina, time for one more question. We got to get you back here. This has been fascinating. What kind of a victory lap is Mario Draghi going to take at G7? I mean, he's on top of the world right now, right?
I don't think he's going to take a victory lap. I think he's a humble person, and I think that he is quietly doing what's right for his country.
Mario Draghi. Wait. I'm sorry, Katrina. Mario Draghi is a humble person, really?
Wow. I think what he's doing and the role he's taking in Italy is doing something that we want all good politicians to do, which is acting in the best interest of the country. And I think that's what he is doing.
I mean, I don't mean to interrupt, but we got to go. But in your research on luxury to find value for Franklin Mutual series, don't you find the Gucci store below the Spanish Steps, the Spanish Stairs in Rome is the most dangerous store in Europe?
I haven't been there because of the travel ban, but I am very excited about the fact that Boris Johnson is now meeting with Joe Biden, and we may be able to travel back to London and hopefully back to Spain so that we can go there in person.
Well, I expect we do a road trip, and we demand a surveillance remote with you from the Spanish Stairs in Rome here. Katrina Dudley, thank you so much on Franklin. You know, Lisa, we make jokes about it, but it is stunning. The move in luxury has been absolutely stunning the last 6-8 months.
Incredibly sticky and incredibly brand specific and able to retain their consumers because guess what? People who had money got more wealthy during the pandemic, and that's the reality.
Seriously, it does show the inequalities out there. Romain, what's your thoughts on this on the close? I mean, the fact is some sectors have been mega winners.
Yeah, absolutely. I mean, look, we knew this was an uneven recession and obviously an uneven recovery. The folks who had money, as Lisa alluded to, actually found a way to make money during this recession, and that's why you've seen the Louis Vuittons, the Gucci's, and all the other luxury brands hold up a lot better than some of the second-tier brands,
Can I just throw out this statistic?
Yeah,
There's a story today showing that the world's wealthiest 500 individuals are now worth $8.4 trillion, up more than 40% in the year.
All right. Well, good morning to all of those.
Well, there's been, but I'm sorry, Lisa. The stock market, what's it up in the last year? 38%?
Yeah, a lot of this stems from that, and a lot of these individuals also were the Jeff Bezoses of the world and people who did innovate, arguably, and lead companies that people wanted
so
to.
what? It's a big number, and they're rich, but hey, it has been, for whatever reason, it's been a boom economy, except for everyone in the triple leveraged all cash fund. We continue important economic data in the next hour. This is Bloomberg.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Inflation expectations are back. I think the Fed is going to need to recognize this risk, certainly over the next year.
The market is becoming more concentrated and less contestable.
Right now, people are focusing on low-quality stocks, whether they're meme or not.
Market, the bond market, is focused on this labor picture.
Well, I think inflation is going to run. That's a good sign. That is a economy getting back on track.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Is there an exit strategy, and does it matter? Good morning. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene, Jonathan Ferro, Lisa Abramowitz, Romaine Bostic, once again, coming and joining us for the rest of the show. There is a question here. We've got summer stasis ahead of key data, ahead of the ECB, the Federal Reserve very much in focus. Tom, how significant is it that there are no signs of caution, that people basically have faith, they have it under control, and can exit when they wish?
Well, stability is there. There's no question about that. And the real unmentioned here, as Romaine has alluded to, is the equity markets have been solid as a rock. There's a bid under it, and a bid can only be there with stability, whether it's the theory of Deutsche Bank out 3 years, that Peter Hooper conversation of earlier this morning, or Lisa, say Ian Lingen over at BMO Capital looking at the short market. Everybody's assuming they get the calculus right.
Yeah,
says who?
Which raises a question, Tom. What economic data point will move the needle?
Well, I'm going to be very forceful on that. I don't think it's one data point. There will be a moment. There'll be some big fancy, tantrum of some type. But it's not going to be one moment. It's going to be a set of data. And we've heard a number of guests say they're watching wage inflation. It's not there.
And Romaine, we're hearing from the likes of Mike Wilson that you're going to get some sort of correction in equities. Are there significant signs of caution at this point?
Yeah, well, there is. There's a lot of signs of caution. You're not seeing a whole lot of hedging, but you are seeing that persistent rotation. These are folks who basically get spooked, but instead of pulling cash out of the market, they find what at least they assume is going to be a safer corner of the market here. Yeah. I think when you start to get concerned is when you actually see that money those flows actually come out of the market and onto the sidelines and back under the mattress where, of course, Keene keeps all of his.
You got that right. Triple leverage to death. What's really important here on radio and TV is in 28 minutes, you're going to see claims. Lisa Abramowitz adamant the claims is more important than the inflation data. We'll have all that for you. We've really got Michael McKee. Hey, teed up that. Speaking of McKee, a surveillance correction of immense import. One of our more elderly listeners today had the folks pop from McKee. McKee was baffled for a moment over the beauty of Grace Kelly. It was not Grace Kelly that danced with Fred Astaire. It was young Ginger Rogers who danced with Fred Astaire. Guys, this was a few years
breaking news.
Wow, that's
surveillance exclusive.
We always correct our McKee down in flames there, and it's a surveillance exclusive. Is that it remains? Save me with a data check. I'm looking at red and green on the screen.
Yeah.
The VIX 17.73. I don't think we've gone anywhere in like 6 weeks.
Not really, and you're looking basically 4,200 on the S&P. That's basically where we've been now, really for the past 7 weeks here, camped out there. The market in relative stasis here. You are seeing a little bit of a bid come into some of the tech stocks, but not much here. And I don't think you're going to see much of a bid until we get that data, until we get a little bit more clarity out of the Fed. 150 on your 10-year yield. We continue to sort of test below that level. And I think a lot of folks say if we continue to sort of hang out right at this level, then you have to start to wonder whether the next step has to be down. That bid coming into treasuries, we saw it with the auction yesterday. That may persist again today with the next auction going forward.
Guy Johnson scheduled to join us from Cornwall. The signing of a new Atlantic Charter today between the United Kingdom and the United States. Right now, widely anticipated, Jeffrey Yu joins us with BNY Mellon, their senior strategist. Jeffrey Yu, the zeitgeist right now, the certitude is it's been one big short squeeze. Everyone was betting on lower bond prices and higher yields, and the trade has swung with acceleration the other way. Do you buy it that it's just a short squeeze?
Perhaps heading into the summer months, people just don't want to take too much risk on in either direction. But given the experience over the past few years, by definition, risk on means actually having equities on, so not as risk off.
Well, do you need to take that?
That's okay, Jeff. You want to get that?
Sorry. Is that Jay Powell calling you up? Hey, Jeff, let me tell you what we're planning.
You know what that is? That's Jeffrey Yu going long on some meme stock today. That's
is that what's going on, Jeff? Listen, we're looking at a bond market, and a lot of people are saying that it's an endorsement of the Fed's view that inflationary impulses are going to be short-lived, and we're going to end up in the same slow inflation kind of environment that we've been in for the past several decades. Do you agree? Is that the message from bonds?
Well, again, the message from bonds is, and they want to know, which type of inflation is the Fed actually targeting. Let's put it this way. We've actually had 2 straight months of soft jobs, soft wage growth now. In Germany, in Eurozone, BOE saying, wage growth, wage settlement's not that strong. The most hawkish region in the world right now, Central Europe, Poland, warning, jobs wage growth is not accelerating at the same pace as before the pandemic. So is inflation really high? But then again, should we be targeting this? Or is the market taking the bet that the short-term supply constraints, they're going to be permanent? And this is going to challenge the bond market and challenge the Fed as well.
Jeff, how many cues should we be taking right now from the commodities market? I mean, we still see oil, Brent crude still camped out around $72. You have a lot of the base metals are either at or sort of near their record highs that they set back in April and May here. How much concern should be baked into reading those prices right now?
I think the market is very concerned, but if you look at what the policymakers are doing, especially in China, what was the biggest marginal pricer for commodity prices globally? China. And China is saying commodity prices are too high, but they are blaming too much liquidity. They are blaming speculation as well. Some of it domestically driven, granted. We saw the monetary aggregates overnight. But on the other hand, they are blaming global central banks as well. So they're saying, look, Federal Reserve, ECB, you're printing too much money, and we have to deal with the consequences here. So China can use price controls as much as they can, but the rest of the world less so. Hence, we should be concerned at the combination of tightening by China and globally to contain these prices.
I look at where we are, Jeffrey Yu, and I'm going to suggest that our radio and TV listeners, their heads are spinning over all the different opinions, all the theory, the econobabble that's out there as well. And to me, it comes down to the time continuum. The x-axis, Deutsche Bank looking out past 2023 with their time bomb of inflation, and others looking wicked short term. That's a Boston phrase. If you're with BNY Mellon, Jeff Yu, you got to have a full understanding of the phrase wicked. What's the x-axis look like for Jeff Yu? What does your continuum look like from now out 1 year, out 2 years, out 3 years?
I'm looking at the next 6 months, actually. I'm looking at
what the ECB will signal in September, not today, but September, talking about tapering. If you're looking at Eastern Europe, they are signaling advancements already, a full rate cycle being priced in over the next 18 months or so. You're seeing some of that within Scandinavia, Australia, New Zealand, like all the list goes on and on. So I don't think we should be blasé and just go BOJ like, 5-year inflation expectations are wherever. It's much more about the short term. And within the next 3 months, we need to see whether these supply issues are indeed short term. But if they are going to be persistent, then central banks probably will have to move. And that's going to introduce volatility into the market.
So, Jeff, what would you be doing right now?
So right now, again, reading the tea leaves in terms of central banks, probably we're in a holding pattern. They're heading into August and September. Look at the event risk. So you want to be light on risk, but then start to factor in upside surprises for vol and for inflation. You've got Jackson Hole coming up, where there's more communication. ECB September meeting is going to be crucial. German elections, is it going to be a new era for Europe, for reflation as well? The UK taper the furlough scheme coming off, and the BOE will decide whether they want to move towards a new regime. So I think all of this could actually happen in the next 3 months. So for those waiting for another year or so, I think that's going to be too late. So risk light heading into summer, but you want to have some risk on in either direction heading into August and September.
Any confidence in the trade of being short government bonds?
So that is still going to be highly contingent, on what the Fed says. I would say for the short term, volatility is going to pick up. So you want to own fixed income volatility, but price-wise, they're going to keep the range in place, because that kind of tightening in financial conditions through lower prices and higher yields, that's going to be a step too far for central banks for the time being. But you want to own fixed income vol.
Jeffrey, thank you so much with BNY Mellon. Greatly appreciate that this morning. As it becomes active here in Cornwall between the United Kingdom and the United States, the G7 meeting starting really tomorrow. I should point out really interesting headlines. One from earlier that I missed. President Biden says we're not seeking conflict with Russia. A number of other ideas here, particularly around vaccination. And then a really important headline in the firestorm of news flow earlier this morning. The president says he will tell the United Kingdom's Johnson he must protect the Good Friday Agreement. Of course, this is on Northern Ireland. In Ireland, the Times of London reporting, Lisa, earlier today, the idea that there was a démarche or formal statement by the State Department. Our Jennifer Jacobs reporting aggressively pushes against what we've heard from the British press here this morning. Jennifer Jacobs saying there is no written agreement. She's making clear, yes, there has been language, but that it is done within a collegiality.
Well, that's the key issue here, the idea of tone, the idea of mood, the idea of trying to come to some sort of friendship, alliance, to regain that kind of bon ami that there once was between the United States and a number of European nations, including the United Kingdom, Tom. And that's really the question. It would be surprising if they tried to undermine that bon ami.
Yeah, the bon ami there, Lisa, that's sort of like what we try to have with Romaine. We usually fail. But, we like to try to have...
Do you feel chummy with us, Romaine?
I do. I always feel chummy here.
This is just so international relations. I can't stand it. Romaine, I look at the equity markets and, the heart of the matter for our listeners and viewers, bonds, foreign exchange and that. Yeah. They want to know what to do with their 401k, and it is a mystery right now, Romaine, within this great bull market and the bon ami of what the Fed has wrought.
Yeah, and a lot of people moved to the sidelines, and a lot of those folks turned out to be wrong, Tom. I mean, this is a market still capped out at those record highs.
And we say with great respect, Stephen Roach, writing here a number of days ago, he's never been more wrong than the recovery of this giant pandemic bull market. Stay with us at Dow, 34,383. We quote that for John Farrow. The VIX, 17.85.
Wicked bon ami.
This is Bloomberg. Stay with us on radio, on television.
With the First Word News, I'm Rich Gupta. Just a few minutes from now, we'll get those latest numbers on inflation in the U.S. The Consumer Price Index is out at 8:30 a.m. at New York time, and according to the Bloomberg Economics Above Consensus estimate, inflation will hit 4.9% for the year ending in May. That would be the highest since August 2008. Economists point to pent-up demand following the pandemic. US and China have agreed to push forward trade and investment links. That came out of the first call between commerce ministers from the two countries since the start of the Biden administration. It's still not publicly clear what the US plans to do with the Phase 1 trade deal signed last year or tariffs on Chinese goods. The U.S. plans to buy 500 million doses of Pfizer's coronavirus vaccine to share internationally. The word came as President Biden prepared to join other group of 7 leaders in a campaign to end the pandemic by distributing shots worldwide. The G7 leaders have gathered for their summit in the UK. And more problems for Deutsche Bank as it heads into the second half of CEO Christian savings turnaround plan. Germany's biggest lender warned of a $365 million hit after a German court allowed some clients to challenge higher fees. Savings plan has been kept on track so far thanks to an unexpected trading rally in the wake of the pandemic. Bloomberg's learned that United Airlines is in advanced talks to buy at least 100 Boeing 737 MAX jetliners. It would be part of a broader fleet revamp. United sees it as a chance to upgrade at a time when Boeing and Airbus are hungry for deals. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Again.
Broadway's returning June.
Have you bought tickets?
He's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
bonds. The best on the Treasury curve, we think, is going to the longer end. I'm talking here about 30-year bonds. If absolutely nothing happens and the market just sits in a range, then you need to be more in the sort of 5 to 7 year part of the curve. But the 30-year is where we really like value. But I think in a global portfolio, you have to diversify.
Yields move lower in stun. Stephen Major once again dead on at HSBC. He's had the big firm call of time. I mean, others have been with him on that. Good morning, Gary Schilling, and the art of disinflation and deflation. But Stephen Major there with a 30-year bond. Lisa, very quickly here before we take precious time with Guy Johnson, to go out to 30 years is a duration move you're not seeing many people take.
No, although you're seeing some people actually encourage that kind of duration move because one way or another, either we're going to go back to low inflation or other people think that the Federal Reserve will have to move much faster than people had expected to stave off inflation and potentially lead to a lower inflation longer term kind of view, Tom. 11
minutes away from key economic data on CPI and, of course, on claims. Our Michael McKee will drive the conversation forward. Right now, again in Cornwall, Guy Johnson. Guy, the G7 meeting, it starts tomorrow. Right now, we will have truly the pageantry of the first meeting of this president with the prime minister. It's a bilateral. What is the first thing that they will bilateral about?
Well, they're hoping to sign, broad brush, Tom, an Atlantic Charter. The last Atlantic Charter was signed in 1941. There is an aircraft carrier over my shoulder that is sailing up and down, a symbolic gesture to this event taking place. In terms of the concrete details that are going to come out of that, that remains to be seen. We are waiting to see whether or not we are going to see some sort of commitment to reopen the North Atlantic. This is a scene setter, though, in terms of the whole event. Boris Johnson hoping to get a commitment broadly from this group in terms of delivering vaccines to the world. That will certainly be a concrete takeaway from this event. I think he's hoping as well that we'll be able to talk about reopening the North Atlantic as well. But in terms of the kind of the pageantry, as you say, of the event, the Atlantic Charter to be signed, hopefully an improved relationship between London and Washington. I think Brexit will certainly be part and parcel of the narrative, Tom. Northern Ireland will feature, but nevertheless, the hope is that this is a rekindling of the relationship.
I mean, the rekindling of the relationship, and this off the Trump years as well. I love the shot. For those of you on radio, spectacular shot of Guy Johnson in the sun and the sand of Cornwall, and in the distance, I believe the Prince of Wales really capturing. It's like a scene from Poldark, Guy. You're killing it. But Guy, you know, seriously here, when I look at the Atlantic Charter, I mean, you're talking some real history here. What does the Prime Minister want to accomplish given Brexit and given the demand that Britain needs global trade?
Boris Johnson wants to position the UK as a international power. It wants to position the UK. He wants to position the UK as global Britain. And I think this G7, what is happening with COP later on this year, is part of that positioning. From a diplomatic point of view, he needs to put the UK on the world stage, and he needs this whole summit to go very, very well. Part of that clearly is his relationship. A huge part of that is his relationship with Joe Biden. It's unclear at this point whether Angela Merkel's going to have a bilateral with the president at this meeting. That may wait for NATO. It may wait for the EU summit next week. So he needs to put Britain firmly in the center of that stage and bringing the president here and having that symbolism and the visuals, I think, very important, both for him domestically and the perception of Britain internationally.
Guy, I love that we're talking symbolism, pageantry. We're not talking about much action. And this comes at a very pivotal time. In addition to not only the vaccinations, which is possibly the most concrete action that we will get from the G7. They're planning to send 1 billion new vaccines across the world to try to help vaccinate less fortunate nations without the vaccine. There is a question of whether anything else will get done on taxes, on coordinating climate change policy. Is there anything concrete that could get done?
I think the vaccines is important, though, and I don't think we should play that down. Because I think it links to a whole range of other aspects of what the G7 is hoping to achieve. The G7, Boris Johnson in particular, wants to position the G7 as a setup in some ways for the COP summit, which is going to take place in November in Glasgow. He needs the nations that are struggling at the moment to get their countries vaccinated to be on board with that process. Many of them are saying, we won't be able to deliver on climate if you can't deliver on vaccines. So getting that done, I think, is hugely concrete. I think you will see a coming together of these nations, and Joe Biden wants to position these nations as a club of democracies, and he wants to position them in a way that he can push back on autocracies. Russia, he wants a strong line to come out of this G7 on Russia and his meetings next week. It is no accident that he's meeting at the G7, then at NATO, then the EU, then he's going to Russia. So I think that kind of, I think you can take that away as something that is going to be concrete. Yeah. The fact that the countries are coming together. Whether China is mentioned, Romain, specifically or not, again, I think China falls within that same camp, though I think there are going to be differences between the EU and the US on China.
Yeah, and we've heard some echoes of that already from National Security Advisor Jake Sullivan and a few other folks in Biden's orbit. I am curious, when you look forward, the idea here that the Biden administration is not only looking for the UK to be a much more reliable ally on the global stage, but the idea that Biden also needs Europe on board as well here. Is there a way that that circle can be squared, given some of the contentious issues that are still on the table between the UK and the EU?
I think you need to segment this and put Brexit to one side. I think Brexit is a thorn in the side of the EU and the UK. I don't think the Biden administration is going to wade too deeply into that relationship. I think at a top, sort of very higher level, it's going to want to make it clear that it does not want to see anything that would damage the Good Friday Agreement. But Romain, I think broadly beyond that, I don't think that the UK and Germany and France and Italy are necessarily on different pages when it comes to the issues such as China and Russia. And I think that is where maybe there is potential common ground. I think when Angela Merkel and the president sit down, they will talk about things like Nord Stream. There are differences between Germany in particular and the United States. I think probably there is more commonality than there are differences, though, still, in terms of the shifting position that we now see. Certainly there is concern in Europe about what is happening with Russia, and there is significant concern, growing concern, about what is happening with China.
Guy Johnson, thank you so much. Greatly appreciated from Cornwall. Just over the shoulder there, for those of you on radio, a beautiful scene with the beaches behind, the Prince of Wales off tooting about ready for the G7 meetings. And in the distance, Bodolak, I believe is how you pronounce it, which was the famous mine in the TV series Poldark. I'm sure Guy will take in the sights.
Why is that becoming a theme?
Cornwall.
What happened to Poldark?
Poldark? Poldark just got older, and it just sort of, went on to the 1820s. Guy Johnson's ancestors were there with Poldark. That's why he picked up the Cornwall beat today. We have inflation data. We have jobs data. We have Michael McKee on radio and TV next.
project and doing a project is something different. And that's why we are so proud. We have started now the first one here. It's running, and I believe that we will see scalability. Now a base to show use cases, so we can develop new cases on how to build a hydrogen economy.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Valuations, particularly sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Surveillance. Good morning, everyone. You need a benchmark. The yield 1.4941% as we move to the inflation and claims reports. And to do that, our Michael McKee joins us. Michael, what do you have?
Well, we're watching the numbers come in here now, and they come in for CPI stronger than expected. The month-over-month change in May was 0.6%. That's lower than it was last month, 0.8, but higher than the forecast of a 0.5% gain. For the core, it's a 0.7 rise, which is 0.2 more than the 0.5% gain that had been forecast on a month-over-month basis. It was 0.9 the prior month. So let's take a look at some of the numbers here in the CPI and what they may mean. The index for used cars and trucks continued to rise sharply, they say, 7.3%. It was up by about 10.2% last month. Food up 0.4, the same as in April. Energy unchanged. Gasoline prices did decline, but of course that's seasonally adjusted. They expect them to go up at this point. So that's the latest on that. And let me just see if there's any other quick notes here. I'll go farther down. Jobless claims, we should get that in here. Initial jobless claims, 376,000. That is a drop from the initially reported 385 last month. So an improvement, but not a great improvement yet.
I'm going to do a data check right now with Lisa. Mike, you dive into the data because this is more important than going to Christine Lagarde in the ECB right now. Lisa, let's be blunt. A 3 basis point move in the 10-year yield gets your attention.
Yeah, and especially given the fact that people waited for a second, they started to parse through the data, and they decided to sell. And as time goes on, you're seeing the yield creep higher, 1.52% now, and we could see it continuing to climb as people look through the data points. Again, what's going to be the distinction between temporary and transitory, Tom?
Now, the 10-year yield comes, the real yield comes in as well from a negative, I'm going to call it 0.85 to a negative 0.82, so that's a lesser negative real yield. Romaine, I got a little bit of softness in the equity market as well.
Yeah, there's a pretty significant reaction here, at least a knee-jerk reaction to the downside here with regards to equity futures here. It'd be interesting to see if some of these losses get paired as folks sort of parse through the report here. It doesn't seem like it changes the longer-term narrative, but I think when you start to see things come in a little bit higher than expected, I think you're always going to get a little bit of reassessment by folks in the equity market.
Well, it churned there, but certainly it churned to a higher yield is how we would call it with the attendant futures. For those of you on radio, these are abrupt moves, but nevertheless, I would call them contained. Michael McKee looking at 42 pages of inflation data. I love, Mike, how everybody thinks it's like two numbers that come out, and it's pages and pages. Within there, what are we talking about? Tomatoes or, used cars? Used cars we mentioned. Where is it?
It's pretty much the same story as it was last month. The transportation numbers as people go off on vacation.
Hotels, car rentals, if you get one.
Hotels, car rentals, rent of lodging away from home. That one drops back to just a 0.4 rise from 7.6%. So they got theirs in here. Owner's equivalent rent does rise. That is the way the government calculates the idea of what home prices change, up 0.3%. Everybody wonders when that's going to change because home prices have been up so significantly. But as we mentioned, used car prices up 7.6%. That's a change.
That's in 30 days, in 1 month.
And airline fares were up as well by 7%.
Yeah, Lisa,
so it's much the same story.
Yeah, I noticed, Lisa, on page 23, summer camp up 42%.
42, just 42? I noticed there's a little bit higher than that.
That was only Tom's camp,
especially after a year of kids being at home. Mike, I'm looking right now at ex-food and energy, and I think that this is interesting. It came in hotter than expected, 3.8% versus the expected 3.5%. Yes, we know when you go to the grocery store, it's getting more expensive. We know that when you fill up your tank, it's also more expensive. Is it telling that this metric is coming in hotter than people expected? I mean, how instructive is that?
It's really not at this point. It's a matter of looking at the individual categories and seeing if we're seeing a broad change in prices, a broad upward move. And while we are seeing many more categories rising, they aren't rising by all that much in most cases. And it does seem to be some of these factors that the Fed would point to as transitory, almost like normalization. I think reflation is a good term as opposed to inflation, because airline fares, of course, went way down during the pandemic because nobody was flying, and now they're getting back to normal. I'm not sure where this leaves us after this month, but they were below last month, but where they were before the pandemic.
With markets on the move and a 151 on the 10-year, we're going to stay with Michael McKee here as Lagarde speaks, reaffirming the headlines that Mike mentioned a number of minutes ago. The key one for me, Romain Bostic, premature tightening poses risk to growth. Inflation.
Yeah, and I think so. And I mean, going back to Mike's point here, too, about the nature of the transitory, I mean, there's a lot of stickiness in some of the, not only the data that we've seen, but a lot of the anecdotal evidence, particularly about what consumers are paying on the ground, whether it's at the grocery store or elsewhere here. And you wonder whether those price increases that they're seeing actually can be transitory if corporations are going to sort of roll those prices back once we get past this period. It's something I worry about, and I wonder if that's why we're seeing so many distortions, not only in the data, but a lot of asymmetry with regards to what people are predicting, Mike, with regards to the economist forecast and where the data is actually coming in.
Well, prices are sticky, so you're not going to see people rolling back prices. The issue is, do we raise prices to take into account the supply chain problems that we're having and the more money we have to pay to get things back to normal? Or do we keep raising prices because we're in an environment where prices keep going up? Now, an interesting thing to look at if you want to go to the beginning of price pressures, and we talk about what's happened with housing, is you look at lumber prices and copper prices, two of the biggest inputs to home building. Those prices have rolled over in the last couple of weeks and have started to go down. Markets do tend to clear. So if this is really supply chain issues, that should be something that we get through. Just depends on the timing. By the way, this is the 5% gain in the headline CPI is the most since 2008. 3.8% for the core is the most since 1993.
And it's not the 12 or 14% in 1947. I can't remember the exact numbers, but still relatively contained. Mike, I've got one final question. I get a wonderful email in from people watching at Man Group. Real earnings still negative. What is the symbolism? You know, it's a secondary statistic, but I got every guest out here telling me all I'm doing is following wages and wage growth. I don't see it when real earnings are negative.
We're still in a period where those numbers are going to be distorted by the composition effects, who's in the labor market and who's getting paid. So that's the problem. It's not so much that the real weekly earnings matter. It would be what you have in the bank, and the extended unemployment benefits and the stimulus checks and things like that made up for some of those losses in real earnings. Before we go, Tom, I will confirm your worst fears. Not only your summer camp fears, but I'm obviously for your daughter, you have to outfit her for camp.
Oh, we do, yes.
Girls apparel up 5.2%.
Yes, that's called the Brandy Melville effect. I want to talk about real earnings. The major real earnings issue is Nick Pivetta of the Boston Red Sox is only making $613,000 a year. That's outrageous. His real earnings should be higher.
Well, based on performance, certainly, yes.
There we go. That'll move the needle next month. Michael McKee, thank you so much on the Economic Derby here. We do this and we say good morning, particularly to all of you in Europe, really leaning on Christine Lagarde's question and answer period. Right now, I believe she's in the statement at the European Central Bank. Let's listen in.
Longer-term refinancing operations, TLTRO 3, plays a crucial role in supporting bank lending to firms and to households. Our measures help to preserve favorable financing conditions for all sectors of the economy, which is needed for sustained economic recovery and for safeguarding price stability. We will also continue to monitor developments in the exchange rate with regard to their possible implications for the medium-term inflation outlook. We stand ready to adjust all our instruments as appropriate to ensure that inflation moves towards our aim in a sustained manner in line with our commitment to symmetry. So let me now explain our assessment in greater detail, starting with the economic analysis. In the first quarter of the year, euro area real GDP declined further by 0.3% to stand 5.1% below its pre-pandemic level of the fourth quarter of 2019. Business and consumer surveys and high-frequency indicators point to a sizable improvement in activity in the second quarter of this year. Business surveys indicate a strong recovery in services activity as infection numbers decline, which will allow a gradual normalization of high-contact activities. Manufacturing production remains robust, supported by solid global demand, although supply-side bottlenecks could pose some headwinds for industrial activity in the near term. Indicators of consumer confidence are strengthening, suggesting a strong rebound in private consumption in the period ahead. Business investment shows resilience despite weaker corporate balance sheets and the still uncertain economic outlook. We expect growth to continue to improve strongly in the second half of 2021 as progress in vaccination campaigns allows a further relaxation of containment measures. Over the medium term, the recovery in the euro area economy is expected to be buoyed by stronger global and domestic demand, as well as by continued support from both monetary policy and fiscal policy. This assessment is broadly reflected in the baseline scenario of the June 2021 Eurosystem staff macroeconomic projections for the euro area. These projections foresee annual real GDP growth at 4.6% in 21, 4.7% in 22, and 2.1% in 23. Compared with the March 2021 ECB staff macroeconomic projections, the outlook for economic activity has been revised up for 21 and 22, while it is unchanged for 23. Overall, we see the risks surrounding the euro area growth outlook as broadly balanced. On the one hand, an even stronger recovery could be predicated on brighter prospects for global demand and a faster than anticipated reduction in household savings once social and travel restrictions have been lifted. On the other hand, the ongoing pandemic, including the spread of virus mutations and its implications for economic and financial conditions, continue to be a source of downside risk. According to Eurostat flash release, euro area annual inflation increased from 1.3% in March to 1.6% in April and 2% in May 2021. This rise was due mainly to a strong increase in energy price inflation, reflecting both sizable upward base effects as well as month-on-month increases, and to a lesser extent, a slight increase in non-energy industrial goods inflation. Headline inflation is likely to increase further towards the autumn, reflecting mainly the reversal of the temporary VAT reduction in Germany. Inflation is expected to decline again at the start of next year as temporary factors fade out and global energy prices moderate. We expect underlying price pressures to increase somewhat this year owing to temporary supply constraints and the recovery in domestic demand. Nevertheless, the price pressures will likely remain subdued overall, in part reflecting low wage pressures in the context of still significant economic slack and the appreciation of the euro exchange rate. Once the impact of the pandemic fades, the unwinding of the high level of slack, supported by accommodative monetary and fiscal policies, will contribute to a gradual increase in underlying inflation over the medium term. Survey-based measures and market-based indicators of longer-term inflation expectations remain at subdued level, although market-based indicators have continued to increase. This assessment is broadly reflected in the baseline scenario of the June 2021 Eurosystem staff macroeconomic projections for the euro area, which foresees annual inflation at 1.9% in 21, 1.5% in 22, and 1.4% in 23. Compared with the March 2021 ECB staff macroeconomic projections, the outlook for inflation has been revised up for 21 and 22, largely owing to temporary factors and higher energy price inflation. It is unchanged for 23, as the increase in underlying inflation is largely counterbalanced by an expected decline in energy price inflation. HICP inflation, excluding energy and food, is projected to increase from 1.1% in 21 to 1.3% in 22 and 1.4% in 23, revised up throughout the projection horizon compared with the March 21 projection exercise. Turning to the monetary analysis, the annual growth rate of broad money declined to 9.2% in April 21 from 10% in March and 12.3% in February. The deceleration in March and April was due partly to strong negative base effects as the large inflows in the initial phase of the pandemic crisis dropped out of the annual growth statistics. It also reflects a moderation in shorter-term monetary dynamics, mainly originating from weaker developments in deposits by households and firms in April, and lower liquidity needs as the pandemic situation improves. The ongoing asset purchases by the Eurosystem continue to be the largest source of money creation. While also decelerating, the narrow monetary aggregate M1 has remained the main contributor to broader money growth. Its strong contribution is consistent with a still heightened preference for liquidity in the money-holding sector and a low opportunity cost of holding the most liquid forms of money. The annual growth rate of loans to the private sector declined to 3.2% in April from 3.6% in March and 4.5% in February. This decline took place amid opposing dynamics in lending to non-financial corporations and to households. The annual growth rate of loans to non-financial corporations fell to 3.2% in April, after 5.3% in March and 7% in February. The contraction reflects large negative base effects and some front-loading in loan creation in March relative to April. The annual growth rates of loans to households rose to 3.8% in April, after 3.3% in March and 3% in February, supported by solid monthly flows and positive base effects. Overall, our policy measures, together with the measures adopted by national governments and other European institutions, remain essential to support bank lending conditions and access to financing, in particular for those most affected by the pandemic. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is necessary to support economic activity and the robust convergence of inflation to levels that are below but close to 2% over the medium term. Regarding fiscal policies, an ambitious and coordinated fiscal stance remains crucial, as a premature withdrawal of fiscal support would risk weakening the recovery and amplifying the longer-term scarring effects. National fiscal policies should thus continue to provide critical and timely support to the firms and households most exposed to the ongoing pandemic and the associated containment measures. At the same time, fiscal measures should remain temporary and counter-cyclical, while ensuring that they are sufficiently targeted in nature to address vulnerabilities effectively and to support a swift recovery in the euro area economy. The three safety nets endorsed by the European Council for workers, businesses and governments provide important funding support. The Governing Council reiterates the key role of the Next Generation EU package. It calls on member states to deploy the funds productively, accompanied by the productivity-enhancing structural policies. This would allow the Next Generation EU program to contribute to a faster, stronger, and more uniform recovery, and would increase economic resilience as well as the growth potential of member states' economies. In doing so, the program would support the effectiveness of monetary policy in the euro area. Such structural policies are particularly important in improving economic structures and institutions and in accelerating the green and digital transitions. We're now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you very much for the opportunity. I have a question on the meeting. President Lagarde, may you tell us how was the discussion of the Governing Council meeting today? How was the mood? As you said, also the uncertainties remain. And what prevailed in the discussion as you decided to confirm the very accommodative monetary policy stance? Thank you.
Well, thank you for that that open question, because it gives me a chance to tell you a little bit about how this meeting went. But let me start with what would be my takeaway of the overall analysis that we conducted, the joint assessment that we had, and the conclusion that we reached. I would say steady hand. And let me drill a little bit into that. We spent a lot of time looking at the quarterly staff projections and went deep into each and every item of those projections. And in conclusion of this work, I think I could say that we were somewhat more optimistic about the economic outlook than we were 3 months ago. I think that the latest signal that we are getting signal a strong rebound, which is starting with the second quarter, and hopefully will be amplified in the third quarter. And I think we took that sort of moderate optimism from the fact that, number one, we are seeing that the vaccination rollout has accelerated significantly and is increasingly outpacing other advanced economies' vaccination rollout. And second, we are seeing that containment measures are gradually lifted. That should lead to a vigorous bounce back in that sector which was most affected, which is the service sector. So when we look at the service PMI, for instance, it is clearly now in expansionary territory. It went up from just marginal 50 in April to now 55.2 in May. Equally, when we look at the sentiment that is regularly published by the Commission, we are also seeing a sharp increase in May, actually the largest increase that they had ever recorded. And we expect private consumption to rise sharply as the containment measures are gradually lifted. So that's good news from the services point of view, which was most affected. Now, when we look at the manufacturing sector, which has earlier on been robust, it continues to be robust. And when we look at the Euro PMI manufacturing, for instance, it has stabilized at very elevated level to be at 63.1% in May. But we also looked into those supply-side bottlenecks that clearly have an impact in the short term on our inflation, particularly now, but for the short-term outlook as well. And that will create some headwinds, certainly. So that's all on the positive front. But we also acknowledged and looked into those uncertainties that we have on the horizon, which has to do with the evolution of the pandemic and how we see, little nest of revival based on another kind of variant. We are also dependent on how fast the containment measures will be lifted, particularly for those countries that are most sensitive to the service industry, the activities that are most a factor of social non-distancing. And clearly, if those containment measures are lifted early on, the tourism season, for instance, or a lot of the transportation activities will pick up. But that's an uncertainty as we look forward. So it's, as a result of that, that our staff increased their projection for 21, 22, and kept it at the same level in 23. So it's been revised up. Then the big job of the Governing Council after that, after it has looked deeply into our projections and what we see in terms of macroeconomic situation, Our job is then to look at the financing conditions on the one hand and the inflation outlook on the other hand, because we do conduct that joint assessment, which we decided back in December, that we confirmed again in March, and which is our monetary policy reaction. So on the financing front, we clearly see broadly stable financing conditions taking together the corporate and the household sector. And there is a little bit of an increase in the corporate sector, which is clearly attributable to two particular countries. One is the Netherlands, the other one is Germany. And this is probably attributable to some, tactical approach taken by those banks in those particular countries to take full advantage of the TLTRO's conditions and to make sure that they catch up with the commitments that they have to take under TLTRO's. But overall, absent those particular factors, we see a little bit of tightening, very, very moderate though, but there is a potential that what we observed on the market interest rates actually could pass through or is at risk of passing through to the financing conditions that are applicable to the corporate sector in particular. For the household sector, not the case, because the financing of the household sector is at rock bottom at about 1.31% interest rate, which has never been so low. So this is the first part of the joint assessment. I'm happy to take you through the second part, which is also critically important, which has to do with inflation, but maybe that's too long an answer.
Oh, go ahead.
Shall I? Well, you're getting a really long answer for a really good question then. So we do the joint assessment, as you know, and we look on the other side at inflation. And as I said in the introductory statement, we are seeing some short-term improvement of the inflation number, and our assessment for 21 is 1.9%, which is clearly north of what we had in our last assessment. But I think we need, and we did that throughout our discussions, we try to really dissect what is underneath and what is the lasting impact of some of those factors. And I think that it's worth reminding ourselves where we were a year ago compared with where we are today, because that's how inflation is calculated year over year. And clearly a year ago, a lot of activities went down, prices were under downward pressure, clearly, and the down movement that we saw at the time has now and is being compensated by an upward movement that we see in many of those prices that went down. Clear example of that is the energy prices, where if you remember, the price of oil and all derivative products went way down and has now recovered, and we see what we call that base effect between 20 and 21. This is clearly the case for it. We will see more of it because there is another base effect that will be attributable to the German VAT. Back a year ago, July 1st, decline of VAT in Germany deliberately in order to support the economy and sustain demand. Well, this has now been reversed, and we will be seeing the base effect in the months to come, which is probably a reason why inflation in some countries, Germany being one, will go north of our forecast for the whole of the euro area. But, and I mentioned earlier on the bottleneck issues, which will push certainly production prices up. But what we need to really focus on, and that's what we did, we need to focus on services. Our euro area activity is roughly 60% services. And services is predominantly labor. And we need to really dig down into the labor cost, into the wages increases, into the collective bargaining agreements that are reached currently and will be reached hopefully in the future. And in that respect, we don't see much by way of service prices going up. If you look at the many of the service industries, prices are not moving much. And that is because wages have not increased significantly. We see a little bit of movement, possibly, and we hope that we will see more of it, and that more of the price pressures are actually channeled into higher wages. But we're not seeing much of that at the moment, probably because of the slack that we have in the economy. Let's not forget that, if you compare with back a year ago, a little more than a year ago, we have 3.2 million more people unemployed. And if you take the combination of the unemployed and those that are under furlough schemes, we're talking about 15% of people who are not on the job. So these particular aspects were really examined in great details to understand what is behind inflation, why it will impact significantly 2021, to a lesser extent 2022, because some of the base effect that I have described for you will begin to fade and will not actually have much of an impact in 2023. But, and that's a but, and it's important, and we discussed it at length, there's something that is moving a bit, and that is core inflation, when you take out energy and food. And on that front, there is a slight movement upward, which has now been repeated for a couple of months. And that's the reason why our forecast for core inflation has gone up a bit to 1.1 in 21, 1.2 in 22, and 1.4 in 23. We are far away from our ultimate aim, close to but below 2%, not there. And we certainly are not where we would like to be once the pandemic is over. But we are seeing some movement there, and we will continue to monitor that carefully. For the moment, certainly, headline inflations, temporary, specific factors that I have just described, and have no reason to believe that it is going to last through and will be included in a rise in inflation that we would see in our medium-term projection. And that leads us to the decision. So that I have, sorry if I was a bit long, but I have taken you through our deliberations throughout.
Thank you. And the next question goes to Alexander Weber of Bloomberg News. Alexander, please.
Good afternoon, President Lagarde.
Good afternoon.
So on the pace of the PEP, so the reference to the first quarter in the policy statement gives you a bit of flexibility. How much fluctuation in weekly buying should markets expect over the coming months, also considering that there's typically less liquidity in the summer? And the second question, if I may, so once the PEP comes to an end next year, inflation will be slowing down again, according to your forecast. At what point do you need to decide on whether to increase buying under the APP or take any other steps to boost inflation over the medium term? Thank you.
Well, thank you for your two questions. So that takes me to the decision, actually, that we made, which is to, as I said, steady hand. So we, based on the joint assessment that I have just described, what the Governing Council has decided, as I read in my introductory statement, is to expect net purchases over the quarter to continue to be, and I would like to quote the introductory statement for you, to continue to be conducted at a significantly higher pace than during the first months of 21. Significantly higher pace than during the first months of 21. Now, we're going to do that in the next 3 months according to market conditions, which clearly include seasonality. And we will do that with the very core attribute of PEP, which is flexibility. Flexibility across asset classes, flexibility across time, flexibility across geography, as you know well. So that's really what we will be doing. And this is done on the basis of, as I said, the quarterly joint assessment that is decided by the Governing Council. And then it's for the Executive Board to actually implement and deliver on the basis of this joint assessment and according to market conditions, including seasonality. On your second question, I'm afraid you'll be disappointed because I might just very well refer to my Lisbon line. There's no point losing ourselves in conjecture. It's too early, it's premature, it's unnecessary to discuss those longer-term issues. And those matters have not been discussed by the Governing Council.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much, President Lagarde. I have one question on your comments that the sustained rise in market rates could lead to a tightening. So I think the market is kind of trying to find out where this threshold is, what is sustained, and which level are you concerned about on average. And my second question would be on the outlook and the strategic review. Is my understanding correct that the strategic review will come first and then you will try and come up with, not try, but then you will come up with a time map for the exit to the PEP?
You're going to be bored with me, but I'm going to repeat myself. Any discussion about exit from the PEP, as you just mentioned, would be premature, it's too early, and it will come in due course. But certainly, for the moment, it's too early and premature, as simple as that. We are in the process of a strategy review. We have been conducting this review for a while. It has been suspended, unfortunately, because of COVID-19 and the enormous amount of work that just landed on the shoulders of the very same staff that was working on the strategy review. So it's some would consider it undue long, and certainly we are working really hard to complete this process, and I hope that we'll be able to give the outcome of the strategy review in the second half of 21. I still stick to that. But anything having to do with PEP and any kind of transition, exit, whatever you call it, has not been discussed. And as I said, it's just too early and premature. Now, concerning tightening, we conduct a joint assessment. The commitment that we made, the monetary policy decision that we made in March, which was in December and then in March, which was both critically important, is to make sure that we preserve favorable financing condition while also being very attentive to the inflation outlook with a view to resisting any downward pressure that would not help in returning to the inflation path of the pre-pandemic period. That's what we do, and that's how we conduct our monetary policy. So I cannot isolate one component. Financing conditions comprise a whole range of indicators from, as I said, financing conditions for corporates, for households, for sovereigns, market interest rates. We take the whole range of financing conditions, we assess that, and then we identify the inflation outlook, the various components, the likelihood of our projections, and we come to a monetary policy decision, which, as I said, is in a way a steady hand translation of what we decided in March.
Thank you. Next question goes to Balazs Korani of Reuters. Balazs, over to you, please.
Good afternoon, and thanks for taking my question. President Lagarde, did anybody at the meeting make the case for a phrase, a terminology different than significantly higher? Did they advocate some other option? And was the decision unanimous? The second question is about the underlying assumptions behind the projections. How did you factor in the Indian or Delta variant? Does your baseline factor in an increase in restrictions in the second half of the year, or do you expect restrictions to be gradually phased out? What are the projections for restrictions on the economy?
The proposal that is made to the Governing Council included the words that I have repeated, which you find in the introductory statement, which is the proposal to conduct purchases at a significantly higher pace than during the first months of 2021. and there was no alternative wording, and there was unanimous support for the introductory statement, and there was broad agreement over what was being proposed. Now, on the baseline and whether or not we take into account alternative variants and evolution of the virus, we will publish later this afternoon our scenarios, because we do have the baseline, and we also have a scenario that is the mild scenario and a scenario that is an aggravated scenario, if you will. And it's in those scenarios that you will find some of the hypotheticals that you referred to.
Thank you. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Lagarde, can you hear me?
Yes, I can. Thank you.
Thank you for taking my question. I have two questions for you today. Given that your medium-term inflation forecast for 2023 is unchanged and remains significantly below target, why are you not stepping up the pace of your purchases to achieve that? Or do you not think that increasing the pace of purchases even further would have any effect on inflation and the output gap in the economy? And the second question I have is on, you talked about bottlenecks and supply shortages. Presumably, given your inflation forecast is for a much lower inflation printout next year, you expect many of those bottlenecks to be cleared up by the end of this year. Is that correct? Thank you.
Thank you very much for your two questions. So on you're quite right that inflation forecast, inflation projection has been revised upward for 21 and 22 and not for 23. And that's for the reasons that I have explained earlier on. There's a base effect, there are some transitory factors, but there is also, and I have discussed that quite a bit, the movement on core inflation. So we are clearly seeing improvement, and that dates back to December, because our forecast for the core inflation outlook has been revised gradually, slowly, by 0.1% over the course of the last projection exercises. So I think that's certainly one of the reasons why we believe that the steady hand is actually the right response in the face of these improvements in core inflation, which we will continue to monitor very carefully. Added to which, you will have noted as well as the balance of risks, which was tilted to the downside in our last projection, is now considered as balanced. That's another signal that the situation is improving. On your second point, because you're right, we forecast inflation at 1.9 this year and 1.5 in 2022. And we assume in that respect that some of the bottlenecks that we know of at the moment, which the Financial Times has referred to in various articles actually, that some of those bottlenecks will gradually fade out, because it is a matter of the supply response. If chips are not being produced in sufficient quantity in a particular part of the world, there will be, in the course of time, additional factories, additional work processes put in place, and possibly offer of products revisited, as we know is the case, for instance, in the automotive industry. So the assumption is, from our perspective, that many of those bottlenecks will actually be overridden by the ingenuity of those who produce and those who revisit their supply chain.
Thank you. Eric Albert of Le Monde, the next question is for you. Eric, please.
Thank you very much. Good afternoon, Madame Lagarde. I'd like to come back a little bit on the significantly higher pace. You said it was supported unanimously. You didn't quite answer the question about was the case for a different pace made by any of the members? Could you tell me that? And the other thing, could you give us your views on the scarring of the economy post-pandemic? Are you more optimistic now that we see the beginning of the rebound than you might have been a few months ago?
On your first point, I said that there was unanimous support for the introductory statement. There was debate on the pace of purchase, on some of the analytical aspects of the use of our instruments, and that's the reason I used the word broadly agreed by the Governing Council. So there was, here and there, a couple of diverging views and not unanimous consent across the board. Okay, so I'm very transparent and very clear. Introductory statement unanimously supported, and some divergence about some particular aspects. Now, scarring of the economy. We are still concerned about the scarring that will be left by the pandemic, whether it's in relation to labor in particular. Economists will use the hysteresis reference, where clearly as a result of change of consumption pattern, change of supply chains, there will be more and different jobs coming up, and there will be more people than was already anticipated that will have to get additional training, that will have to adjust to new tools and possibly acquire completely new skill sets. So that's one of the reasons why we believe that Next Generation EU plan is a critical financing element to actually transition into the post-pandemic period and help those that will be most affected by the scarring impact.
Thank you. And the next question goes to Klaus-Rainer Jakisch of ARD Television. Klaus-Rainer, please.
Good afternoon. Mrs. President, my first question relates to inflation. Some leading economists have suggested that the pandemic has caused much more structural and fundamental changes to the global economy, similar to what we have seen after, in different way, of course, after the financial crisis. And they suggest that inflation probably will become a much more persistent problem, and inflation will stay on a much higher level than, especially not only the ECB, but also other central banks suggest and expect at the moment. What do you think of these ideas? And my second question relates to the Bitcoin. As you're aware, El Salvador has announced to make the Bitcoin now as an official currency. Are you concerned about this move? Thank you very much.
On the inflation having more persistent impact as a result of the pandemic, I'm assuming that you're referring to economists such as Larry Summers, maybe Olivier Blanchard, and a few others. I think that their point has more to do with the massive stimulus that has been given by the various plans, including in particular the last Biden plan to be voted of over $1.8 trillion, and the fact that there might be overheating as a result of that, and therefore inflation that would be higher than what is currently expected. I think that the US economy situation and the euro area economy situation, it's a very, very different story. The two economies are at a different point in the recovery cycle. They start from a completely different base. The fiscal stimulus that have been put in place, at least in end of 2020 and beginning of 2021, are of a different magnitude. And as a result, whatever is ultimately the characterization, the longevity of the price upward pressure that would occur in the United States, I think, is completely different from anything that we will see in the euro area. Although, of course, there will be some spillover, as I think I've indicated at our last March conference, as a result of the Biden plan. But certainly of too small a magnitude to actually make a huge difference. But we will be, pandemic is also a factor of what happens domestically, but also what the spillovers from the global economies will have on a domestic economy, and we will be very attentive, and we will look into that as we look carefully at the exchange rates as well. On your second point, I'm no longer familiar with the situation in El Salvador. I know that it's a country that is under IMF program. I think the issue of having a dual tender in a particular economy is a difficult one, and that certainly does not change our approach to crypto assets and to the regulations, supervision, and proper classification that they should be under in order to avoid misinformation and misleading representations.
Thank you. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Hello, Madam President. Do you hear me?
Yes, I can hear you well.
I would like to know if there was some divergence too regarding the balance of risks. Did any member felt like it should be tilted to the downside or to the upside and no broadly balanced? Thank you.
You know, as I said, all the key points that are in the introductory statement that I have read to you have been agreed and have been seen as acceptable by all members. We did debate. You know, this is the beauty of us being together. We did debate whether it was right to actually move to this slight downside risk that we had back in March to this more balanced assessment, to this assessment of more balanced risks, and there was general consensus around that.
Thank you.
And one second question, if I may.
Okay, you may.
It's about the digital euro. I would like to know if we are going to hear some news in July, as the market is expecting. It will be in the monetary press conference, or maybe in another conference or press conference.
Well, you will definitely hear about the decision that will be made by the Governing Council concerning the digital euro. But I just would like to warn you in advance that this is not, you know, the final go. I think my colleague and board member Fabio Panetta has explained that very, very clearly. Mid-July, the Governing Council will approve to go ahead into an exploration phase that will include multiple aspects, from technology to privacy to inclusion and everything in between. So it's not as if, you know, the decision was final and made. Exploring all these matters will actually take a lot of effort, a lot of digging, and will bring together the whole euro system, because it obviously involves all the NCBs around the ECB on this matter. Yeah. But you will obviously hear about it. But all I'm trying to say is, let's not assume that we are jumping to conclusion. This decision will be, do we explore further, or do we not spend much more resources on this project?
And the next question goes to Mark Boinderman of NRC Handelsblatt. Mark, please.
Yes, thank you. Can you hear me, President Lagarde?
Yes.
Yes, thank you very much. You just said that the decision on the pace of purchases was broadly agreed. Could you perhaps sketch out a little bit how that discussion went, also from the point of view of those who were not in the majority, so the dissidents? And secondly, if I may, U.S. inflation just came in at 5%, which is high and also higher than expected. Do you view a risk or a possibility that U.S. inflation will trickle through to the Eurozone? Thank you.
Well, thank you very much. You know, as I said, the Governing Council conducted this joint assessment of the financing conditions against the background of the inflation outlook, and then the decision was made to continue to purchase at a significantly higher level than during the first few months of March. And as I said, there was some debate about that, because obviously we had to analyze both the financing conditions and the inflation to lead us to the decision that was made. But the decision is very clear and straightforward, and everything that is actually embedded in that introductory statement was supported.
Thank you. And the last question goes today to Tom Fairless of the Wall Street Journal. Tom, please.
Yeah. Hi, President Lagarde. Thanks a lot for taking the question. I wondered if you saw any risks from the this very aggressive monetary stimulus on both sides of the Atlantic. I mean, you see housing prices going up. Do you see any longer term risks emerging? And secondly, maybe on the U.S. comparison, you said that it seems like you're watching quite closely what's going on there. Do you expect a longer period of divergence between the ECB and the Fed? Thanks.
Concerning your first question, what we always do when we make a monetary policy decision is to assess the effectiveness, the efficiency, and the proportionality of our measures. And as a result of that, we have to look into the potential side effects or the real side effects. And certainly, as far as we're concerned for the moment, the benefits that we have from the monetary policy decision that we have taken, going back to the beginning of the pandemic, back in March 2020, up until now, is that it largely outweighs the indirect effects that you're referring to. I would also add that in relation to some of those risks, there are alternative measures that can be decided either from a macro or from a microprudential point of view or from a fiscal point of view. But all in all, when I look at the counterfactuals, what would it have been? Where would we be had the European Central Bank not made the decisions that it made to make sure that we were not going to move and morph from a pandemic situation to a cataclysmic recession situation that we would have had? So I think that by doing what we did, we made sure that financing was flowing into the economy and that any risks of poor monetary policy transmission would be avoided. And by the same token, we also enabled fiscal policies to be supportive and accommodative as well. So it's the joint fiscal and monetary approach that was so critical in order to actually resist what could have been a very, very dramatic spin into a disastrous economic situation. So as I said, I think that comparisons are odious, but comparing the U.S. economy as it stands and the euro area economy where it stands and as it stands, I think is not in the cards, because, as I said, we are, in terms of inflation, we're starting from a different base. In terms of fiscal stimulus in 21, different story as well. And in terms of point in the recovery cycle, not the same place yet. Although, clearly our vaccination rollout is accelerating and now clearly outpacing the vaccination cycle that the United States and other advanced economies are going through. So, of course, when you look at inflation, there are domestic factors, as I said, and we have to be attentive to the global situation and how other economies, whether they are advanced, including the largest one, or whether they're emerging economies, how they are faring. And that has spillover effects, or that has impacts. But are we exactly in the same point in the cycle? No.
Thank you, President Lagarde. That brings us to the end of the press conference. Thank you very much for following us. The next regular press conference is scheduled for the 22nd.
From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. This is Countdown to the Open. We have been watching the press conference with ECB Chair Christine Lagarde talking all about how they plan to remain dovish with their accelerated bond purchases. If you take a look, you can see that euro continue to weaken as she talked versus the dollar, as people continue to expect an easy money policy. You also saw Italian bond yields move lower, peripheral spreads tighten as people look to the prospects of accelerated bond purchases under the PEPP for a prolonged period of time. If you take a look at 10-year yields, contained after higher than expected inflation read from the CPI, but still higher on the day. Across the board, you are seeing strength in stocks. S&P up 0.4%. The market just opened in the United States. Stocks Europe 600 up 0.2%, and the banking index actually up 1.4%. Kind of interesting. The European banks are higher on the day, with the ECB sticking to script and saying they're going to remain dovish. President Lagarde saying it's too early to even talk about a potential bond buying exit.
Any discussion about exit from the PEP, as you just mentioned, would be premature. It's too early, and it will come in due course. But certainly, for the moment, it's too early and premature. As simple as that. Anything having to do with PEP and any kind of transition, exit, whatever you call it, has not been discussed. And as I said, it's just too early and premature.
If you were hoping for a discussion of an exit strategy, forget about it. For more, Bloomberg's Maria Tadeo joins us now from Frankfurt. That, to me, was really the headline, Maria. What were some of the highlights there?
Yes, Lisa, there's a lot to go through. First of all, and this is really the point, and that was a message from the European Central Bank, is that the PEP program, that is the pandemic QE line, stays unchanged, stays put for the summer. The statement was very clear about this. That one line saying significantly higher. There's no doubt about that, and she repeated that numerous times during the press conference. Now, when it comes to the outlook for the European economy, she also said it now looks broadly balanced. She also pointed to the fact that the vaccination campaign is really accelerating and picking up. Now, 50% of Europeans have now received at least one dose of the vaccine. There will be herd immunity by the end of July. Now, Lisa, what I thought was interesting here was a message on inflation. On the one hand, she did say we're not there yet, we're not close to our goal, but something is moving. She did say on the PEP program, too, that the statement was unanimous, but there were some divergence on the PEP itself. So to me, what that suggests is that the European Central Bank stays put for the summer, but there will be a real debate starting in September.
All right, so Maria, just to sort of wrap this up, it's being taken by the market as a broadly dovish statement. You're seeing spreads contract, whether it's the Italian yield or other peripheral bond spreads. There's a question of whether this is the correct response. Are you seeing hawkish signs, potential talk of tapering down the line?
Well, look, listen, I have to say the usual hawks have not been asking for tapering or anything that looks like tapering. If anything, what we would get in September is not a direct call to taper, but actually a way to start this debate. You know, she did say right now there is momentum going into the economy, but all of this is driven by the pandemic. There is uncertainty when it comes to the variants, and there's still big uncertainty in terms of industries that are not fully recovered. So I would argue, you know, the hawks are not really speaking loudly, but after the summer, the picture may change.
Thank you so much to Bloomberg's Maria Tadeo. The ECB renewing its pledge for faster emergency bond buying, writing in its statement, quote, the Governing Council expects net purchases under the PEPP over the coming quarter to continue to be conducted at a significantly higher pace than during the first months of the year. Let's bring in Invesco's Alessio De Longas and JP Morgan's David Kelly to discuss what we just heard, whether it's worth it to dive into European assets. David Kelly, what's your view? Do you think that this is risk on in the Euro region as they continue to purchase an accelerated prospect of bonds each month?
Sure. I mean, European stocks are a lot cheaper than U.S. stocks. They are actually more cyclical than U.S. stocks. The technology sector is a smaller part of the story. And, you know, I think Christine Lagarde made it clear that monetary policy is going to be very easy. But, you know, she's right. The pace of vaccinations is picking up. Europe is in a different place, but only by, you know, it's not. I think the prospects in Europe are very positive also. I think you will see a strong pickup in growth in Europe, and perhaps even with a smaller risk of a sort of boom and bust. So I'd very much be in favor of European stocks just recognizing that their recovery is a little bit slower or a little bit behind the U.S. in terms of timing here.
Alessio, I'm wondering your view, with particularly a nod toward European financials, which we are seeing outperform today, despite the decline in yields. Is your view that European financials is the way to go right now?
Indeed, and actually the rationale aligns very much with David. What the ECB delivered today is a continuation of the status quo. And while policy is dovish and on the surface, because of the shape of the yield curve and the prospect for higher or lower interest rates may affect financials, but I think the bigger picture is actually from an equity flow perspective. The status quo with very easy monetary conditions allows for a continuation of the global rotation from growth into value. And when you look at it that way, financials, first of all, as a sector, and European stocks more broadly as a region are the segment of the market that loads very strongly on that value rotation compared to other sectors. So we think that while we may be counterintuitive from a daily reaction today, but actually on a medium-term perspective is the correct market response.
We've been talking all morning about the Goldilocks market, the idea that monetary policy will remain easy even though growth is picking up. And then you also have the fiscal expansion. The consequence of this potentially, though, is inflation. Deutsche Bank's Peter Hooper expecting that this coordinated policy response to introduce a new inflation regime, writing the following: we are witnessing the most important shift in global macro policy since the Reagan-Volcker axis 40 years ago. Never before have we seen such coordinated expansionary fiscal and monetary policy. This is why this time is different for inflation. David, if that is the case, why are we looking at 10-year yields in the U.S. at 1.51%?
The markets are getting this wrong. I mean, we are seeing an acceleration in inflation. What I think markets miss is and have missed for some time here, is there's a big difference between fiscal policy and monetary policy. Monetary policy is like leading the horse to water. You can't necessarily get the horse to drink. You can't promote stronger investment spending, stronger economic activity through very low interest rates. But if you give money to low and middle income consumers, they will spend it. And I think that print on CPI up 5% year over year ought to be a wake-up call. I mean, we think that's going to translate into about a 4% year-over-year increase in the consumption deflator, which the Fed looks at. But if you look at the consumption deflator over the last 2 years, it will be up about 2.2% per year. So we're already blowing through their long-term 2% forecast. I think there's plenty of fuel for further inflation here. And I think the bond market is just, maybe there are no bond market hawks left around. Maybe it's so long since anybody's seen inflation they can't recognize it. But I see inflation building because fiscal policy is a far more powerful tool in promoting stronger economic growth in the short run and inflation than monetary policy ever was.
Alessio, do you agree that the bond market is getting this wrong?
Look, I think that the perspective shared by David is absolutely correct. Now, with respect to the pricing and the market getting it right or wrong to the level of interest rates, I would add an additional nuance there. It's true that we have global fiscal coordination that is far more important than monetary policy, but we also need to, we still have not fully appreciated the impact of the pandemic. You have to think about the subsidies in the U.S. Coming to an end in September. What will that do to the increase in the participation rate, and what will that do to wages, number one? In Europe, because of the lockdowns and the fiscal support, we also haven't really seen the full picture of potential layoffs in the future. So what I'm trying to understand still, I think it's still an open question, is whether all this fiscal support, is it additive to the private sector, or is it replenishing future loss of private sector demand, right? What I think we can rule out, and has been an absolutely successful story, as David said, is that it looks to us that this recovery is not going to be like the recovery post-GFC, where we entered a fiscal austerity regime very early on and basically worked with the threat of disinflation or deflation for several years. I think this fiscal policy run is doing a great job at eliminating that left tail of persistent disinflation or deflation.
Alessio DeLongis and David Kelly, we're going to elaborate a little bit more in just a bit on the inflation debate and some of the numbers we got this morning. Right now, let's head to the markets desk. Bloomberg's Abigail Doolittle has some of the stocks moving at the opening bell. Abigail.
Lots of green on the screen, Lisa, because of course we're looking at the first all-time high for the S&P 500 in more than a month. Despite that inflation number, investors not worried. It is helping one sector that lagged yesterday, the financials. Lots of the big banks are climbing higher as yields tick higher on that inflation number, that slightly hot CPI print. But the real strength, it of course is coming from tech, which is counterintuitive because usually when we have rates going higher, that tends to weigh on tech, but not so much today. Look at Amazon up 1%, Microsoft up 0.8%, and even Apple in its correction getting a small bid. So that's really helping out. And then finally, if we turn to the meme stocks, we are going to see a bit of a mixed bag. We have that rotation going on. GameStop down, of course, they're offering more shares, taking advantage of the big run up. They are also talking about the SEC trading investigation, so overall weighing on the shares. But AMC in the pre-market had been down, now bouncing back, and we have two new meme stocks to add to the count, Lisa, the original BART company, a pet company, and then Microvision. That company, that stock, will be added to the Russell 2000 later this month. There could, with that rebalance on the 25th, be some volatility. More to come, Lisa.
Abigail, thank you so much. Coming up, another month, another upside inflation surprise. What the latest figures mean for Team Transitory as stocks hit a fresh intraday record high. That conversation coming up next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều những cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Fed really needs to see is that 7.6 million people who are still on the sidelines relative to pre-pandemic levels versus where we are today start to re-enter the labor market. And once they start to re-enter, we think that these wage pressures normalize and that these inflation risks start to dissipate. And that allows the Fed to be patient and go along their normal course of action.
The great inflation debate continuing. Morgan Stanley's Jim Caron expecting the jobs data to be the needle that moves the Fed. This, as yet another upside inflation surprise, adds more fuel to the transitory debate. For more, let's bring in Bloomberg's international economics and policy correspondent, Michael McKee. A slew of data today. What stands out?
Still too early for Jim Caron's ideas to come to fruition, unfortunately for him. But we do get stronger than expected CPI data with a headline consumer price index up 0.6%. That's down from last month, but higher than we had forecast. And that pushes the year-over-year rate to 5%. Haven't been there